what we have seen is a much higher baseline level of volatility for technology stocks.
Some of these moves have been absolutely parabolic.
It's becoming a little bit more consensus, at least, to lean a little bit more into the hyperscalers.
You got the hyperscalers. They're spending like drunken sailors.
Can the build of AI get done as fast as the market expects?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, struggling to hold on to gains, heading into the beginning of quarterly earnings from big tech as oil hits 6-week highs following the 11th day of strikes on Iran, leaving Japan facing more pressure to stem the rout in the yen. The yen bouncing off a 4-decade low.
You know, we keep talking about, Julian Emanuel has said this is very much a market of stocks and specific stories, not a stock market or other types of markets. And the Japanese yen is a perfect example of this, given the fact that ultimately we've asked how long can they keep burning cash to support their currency. It turns out at a certain point, the Bank of Japan has to get in on it because, yes, they're talking about potentially having some intervention coming from the finance ministry. At the same time, that isn't enough. So you do have some speculation that Japanese monetary policymakers may hike rates more frequently than once every 6 months. Maybe that'll give a boost. Does this job owning work if there isn't action behind it?
Stay on that chart. Dollar yen at 163. That's an intraday move. Look at the size of the move this morning. They're throwing everything at it. Talk is cheap. The Japanese finance minister talking about taking appropriate and bold action at any time should the need arise. I'm guessing the need has arisen because we got reporting here at Bloomberg that now the BOJ is considering going faster than a 6-month hiking pace. And even with that reporting, you've got a 0.1% move off a 4-decade low on dollar yen.
They have a credibility problem right now with just using talk, just using verbal intervention. And that is ultimately what that chart is showing and what you're highlighting right now, which is they've talked a big game, but they haven't followed through. And even with respect to the consecutive interventions that we've seen from the finance ministry, it hasn't staved off the declines that are structural, given where the monetary policy is being pushed, which is to be easy to allow growth.
They're getting bullied right now by the price of crude. It's a terms of trade shock for them and many others as well. Check out the price of crude this morning. WTI and Brent, we have breached 95 for the first time in 6 weeks on Brent crude. We've added $20 in the last few weeks.
And the rhetoric at the moment is not getting better, at least if you'd like to see the Brent price go lower. 11th straight day of attacks last night. It's the first time in almost 6 weeks that you're seeing this Brent crude price, and that is because not only do we not have the attacks continue, but you have the Iranians coming out and saying, we're not negotiating, we're just exchanging messages. The president saying he will respond if the Houthis get involved, and so much that there is a concern that the European naval force is actually telling some European vessels, don't use the Red Sea anymore. Just the threat alone is having people to react.
Investing is an emotional game in many ways. Oftentimes, and this right now is one of those times. 95, I don't want to see that. I don't want to think about it. I don't want to internalize it. It's not happening. 88, whatever WTI is this morning, don't want to think about it, don't want to internalize it. It's not happening. Then yields start to creep higher. And all of a sudden, the yield on 2s, 10s and 30s starts to look just a little bit different. You're starting to push towards 430 on 2s, on 10s. You're still around 460 on 30s, comfortably above 5%. And the more you see these kind of moves, the longer it continues, the more of a problem it becomes to take risk.
Over to you to the ECB, which will come out tomorrow and have to deal with this boiling the frog type of environment, at least for market participants. From the market's perspective, there have been so many cross currents of stories, in particular tech, which will take the oxygen out of the air later today, with tech earnings that people are going to try to ignore what's going on in the Middle East. But you cannot ignore when real yields on 10-year treasuries reach the highest levels going back to late 2023, when you start to talk about what the potential is for there to be overly easy policy if the Fed does not respond to this. And ultimately, does the ECB muck it up again with potentially growth expectations declining on both fronts when it comes to Europe?
Look out for that in the next 24 hours or so. We've had a close to 30 basis point move on the German front end of the curve, 2-year, in just the last few weeks alone so far this month. Equity futures on the S&P 500 down by about 0.2%. Coming up this hour, we'll catch up with Max Kettner of HSBC, warning of risk ahead. General Karen Gibson of Academy as President Trump dismisses hopes for Iran peace talks, and Angelo Zino of CFRA on the high bar for big tech earnings. We begin this hour with stocks pulling back after snapping a 3-day slide. Max Kettner of HSBC suggesting warning signs are building. He writes the following: it may well be time to reduce risk in portfolios after the peak earnings season in 2 weeks' time. Max joins us now for more. Max, welcome to the programme, buddy. This one surprised me.
Hello.
I get your research every week. I was going through the note, and I'm always looking for it. When is Max turning less bullish? This note came really, really close, Max. What's changed?
I think there's a couple of things that changed. Now, when we look at the price action just the last 6-7 weeks, of course, that's been largely the semi unwind. So let's be honest, if you had told me semis are going to go down into actually a bear market and the overall S&P is actually flat, I would have taken it any day. So that still looks pretty good. But we've got to face it that actually outside of that, the rest of the S&P isn't yet participating so much. So I would say now with peak earnings season coming in the next sort of 2 weeks, there's two possibilities. Either the earnings season propels us even higher, particularly from a broad-based perspective. So the equal weight S&P really performing well. That means things like breadth measures, like things like members of the S&P above 50 or 200-day moving averages, that really going to the highest from where we were in 2023 and 2024, that then would say, hey, you know what else is there to buy? That there's no more marginal stuff that is actually lagging that I can buy. And that's one possibility. The other possibility is we don't see actually that even broad-based earnings surprises propel the market higher, both of which would be pretty bad. The other thing that's clearly changed is sentiment and positioning. When we look at our measure of particularly sentiment among long-only investors, that's now starting to push towards where we were during the reopening trade, that sort of peak bullishness in 2021. And that surely from a positioning, from a sentiment perspective, when everyone's getting so bulled up, is not a positive going forward.
Max, I just want to highlight something you're saying here. I think it's important. What I'm hearing from you is don't look for the earnings, look for how the market responds to the earnings. That's going to be far more important to you over the next 2 weeks.
Yeah, absolutely. I think absolutely, particularly when you compare Q2 versus Q1. Let's face it that when you compare and look at year-over-year earnings expectations, of course, everyone says, oh my God, the bar is so much higher. That's not true. It's just the year-over-year that is higher, and that is largely a result of the really, really good earnings season that we had in Q1. Let's remember that in Q1, we had the highest earnings beat rate in the S&P 500, really, since the second quarter of 2021. And we had the highest average earnings surprise, right, across the S&P 500 companies since Q1 2021. Really, since that reopening trade, we had an average earnings surprise of almost 20%. Well, of course, the year-over-year rate expectations are going to be high then, but the sequential ones, the quarter-over-quarter ones, when you strip out energy and materials, you end up with net income expectations from consensus at about minus 3.5%. So I do think we can get pretty broad-based earnings surprises again. I wouldn't be surprised if we get similar magnitude of earnings surprises in the broad-based sense, median earnings growth, comparable to what we had in Q1. And then it really depends what the market is doing. Are we going to go and get a broad-based rally? Then you want to take some risk off because probably positioning and sentiment goes even closer to a sell signal. If we don't see that coming, then I'm afraid to say it's like, well, what's going to propel us even higher here? We're flat even, or we continue to be flat even with broad-based earnings surprises. In both cases, I think then into September, October, you want to take a bit of risk off the table.
Max, you're in an uncomfortable situation. Waiting is not something that seems like traders enjoy when they're looking at markets and saying, we don't know exactly how this is going to play out. What are you doing in the next 2 weeks? Are you just sitting on your hands, biting your nails and watching the earnings?
I mean, I'm hopefully not biting my nails, but I'm waiting and I'm still max overweight stocks. So we are, leaning really still into that broadening of the market. We're still overweight the equal weight S&P. We're still overweight Europe. So we've already been rotating out of emerging market equities in the last couple of weeks, out of Asia, more into the likes of the Mag 7, where, again, the earnings bar, the bar to beat, both in terms of the numbers, but also in terms of the narrative, is so low. It's leaning into the equal weighted S&P, leaning into value more, so Dow Jones. So a little bit still away from momentum. That also means Europe. It means European banks. It also means the dip that we've seen in Japan, particularly things like Japanese banks. That really doesn't make sense. So those are the sorts of things that in our asset allocation, we're still really, really heavily overweight in the next few weeks.
Max, John was doing a great job of laying out the boiling the frog scenario that's happening in the oil markets and how that's bleeding into yields and just valuation expectations going forward. When you look at something like the 10-year U.S. real yield at the highest level going back to October of 2023, what do you do with that? At what point does that start to offer its own pressure to the bullish narrative, separate to potentially earnings and the reaction in markets?
Yeah, I think you said it right, Lisa. I think the first step is really going to be earnings. So we are what we call that danger zone. I've been talking about it in this program quite a lot in the last 6 months as well. We are actually in the middle of that danger zone. But as long as you've got these really, really low sequential earnings growth expectations, for the next 2-3 weeks, it doesn't matter. Then I think if real rates really continue to push a little bit higher, then that's going to be an issue. But for now, it's really the earnings expectations, the earnings season. What I would also say, however, on the real rate side, I'd be actually more concerned if real rates were still lower, because in reality, that means the market has now already turned hawkish. It has already priced in those rate hikes. It has reacted to better data, to consensus now really starting to believe in that U.S. exceptionalism picture. What I would say, when you look at something like Fed sentiment on Fed minutes or things like Fed speeches sentiment, that's already pushing towards really the most hawkish since 2022. So I do wonder going forward now into the next 4 or 5 months, that actually, aren't we all believing a little bit too much into that US exceptional picture? Are we not extrapolating a little bit too much the strength in H1, this fiscal impulse strength, that the almost 20% higher tax refunds that we had in H1? Are we not extrapolating that too much into H2? And isn't there then a bit of a downside surprise potential? Nothing recessionary, but just the US not being as exceptional, just great, but not as exceptional. And that, of course, actually from a real rate and then from a risk asset valuation standpoint, perhaps after the midterms would be really good in a classic sort of bad news is good news regime, because we could price out the threat of rate hikes then.
Hey, Max, it sounds like you're on the edge of buying Europe at the end there.
Yeah, absolutely. I mean, it is, I think, now a picture of, okay, maybe into the midterms, with a little bit of too bullish positioning behind the earnings season behind, maybe, and obviously seasonality, right? September, October, maybe you'll take a bit of risk off. But I think after that sets us up then for a really nice renewed rally again.
Interesting, Max. It's good to see you, buddy. Thank you. Max Kettner of HSBC. Nice cover story on Max this week from Bloomberg, right? See the pictures?
I didn't see the pictures.
It's like a runway shoot, wasn't it? Like a fashion shoot.
Vogue. That's what
for Max Kettner. Let's talk about this market then. So rates have repriced. Crude has repriced. Earlier on this year, we had the comfort blanking of a massive positive earnings surprise to insulate us from what was happening with rates and the volatility in energy. Can you repeat the act twice? With earnings, not once, but twice, and that's what Max is focused on in the coming weeks. The
positioning and how much people have already overweighted these upside surprises, and if they cannot be pleased by what they see, which is something that we saw from Samsung, for example, does that signal that we're reaching peak positioning, which gives perhaps a bit of shade to his bullishness?
Just off 95 on Brent, no one wants to talk about it, do they? Every time we cover this story, you can just feel the anxiety. We talked about it just the other day. You bring up the story with crude, you bring up the price and you say 95 on Brent, WTI 88, and you just feel like people are throwing their breakfast at the TV screen.
Well, we heard from Francisco Blanche yesterday, and he was saying that potentially if we go above 100, if the escalation continues. Goldman Sachs is saying if we continue in the phase we're in right now, we're looking at 120 towards the end of the year. These are incredibly high numbers. And right now, when you look at the rhetoric coming out of both these countries, it looks like we're going to continuously be in this messy situation.
We've got a 4% move on crude so far this morning. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, good morning. The US is widening its airstrikes on Iran in an 11th straight night of attacks. Tehran responding with strikes on US facilities in Kuwait and Jordan. President Donald Trump saying he's not worried about Iran-backed Houthi militants threatening to impose a maritime blockade on Saudi Arabia in the Red Sea. President Donald Trump also preparing to impose 100% tariffs on generic drugs. The new levy will go into effect in 2028 and will increase to 200% the following year. In a Truth Social post, the president writing, this is done in order to reshore generic pharmaceutical producing into the United States. The yen back above 163 and close to its 4-decade low. The currency strengthened for a brief spell earlier after we reported Bank of Japan officials are open to raising rates at a faster pace than the expected 6-month tenor. This as continuing weakness in the currency is adding to upside inflation risks. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, blowing off talks with Iran.
We are doing very well. We are degrading them at levels that nobody thought was possible. They want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest.
Up next, we'll catch up with General Karen Gibson of Economies Securities, live from New York City this morning. Good morning. Futures decline. We're down by a third of 1% on the S&P, and the Nasdaq we're down by 0.7. Yesterday on the S&P, the best day of the month so far, a gain of 0.9. Chips helped out big time. 5% rally on semis. This morning we take some of it back, declining across the board. The Y in the bond market, yields still elevated, 2s, 10s and 30s, 2s around 425. In commodities, crude very much elevated, taking out 6-week highs a little bit earlier, $95 a barrel on Brent crude, $94.50 as things stand, higher by close to 4%. Under surveillance this morning, blowing off talks with Iran.
We are doing very well. We are degrading them at levels that nobody thought was possible. They want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest. We'll be hitting that area pretty soon, and very heavily.
So here's the latest this morning. The US striking Iran for the 11th straight day. The Trump administration downplaying chances for talks between the two sides. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, despite mediators' efforts to prevent further escalation, tensions appear to be pointed there as the U.S. expands its scope of targets. Yesterday, President Trump said that the military will soon heavily hit what's known as Pickaxe Mountain, which the U.S. and Israel suspect to be a nuclear site. Now, President Trump says that behind closed doors, Iran wants to make a deal. But as you heard, he says the U.S. doesn't want to come to the negotiating table unless Iran does in what he called a meaningful way. But publicly, we've gotten very little indication Iran is willing to let up its leverage when it comes to disrupting global energy supplies. And it's not just in the Strait of Hormuz. Yesterday, new tracking data shows that at least 2 tankers filled with Saudi oil made U-turns as they approached the Red Sea. Amid that threat from the Iranian-backed proxy group, the Houthis now risking the nearly 4.5 million barrels per day that Saudi Arabia exports via the Red Sea. And John, the longer the strikes go on and the U.S. maintains its own naval blockade, that is raising questions here in Washington about U.S. resources and stockpiles. Yesterday, we saw Pentagon officials on Capitol Hill asking lawmakers for nearly $67 billion in supplemental funding, as the U.S. Defense Secretary Pete Hegseth says that the war has so far cost Americans $37.5 billion so far.
And climbing. Tyler, thank you. Tyler Kendall with the latest in Washington. Let's build on this. General Karen Gibson of Economy writing, the current cycle of violence is about who will determine the rules governing one of the world's most strategically important waterways. Expect continued U.S. strikes and Iranian retaliation. General Gibson joins us now for more. General Gibson, welcome to the programme. I wanted to unpack this headline that crossed about 20 minutes ago. It came from Secretary of State Marco Rubio. He said the United States is targeting places launching attacks on ships. I want to unpack that because I think it's important. The strait is small, but the coastline is massive. Can you flesh out just how difficult it is to achieve what the military is trying to achieve right now?
Yes, it is a tremendous advantage that Iran has, Jonathan. We are doing, as has been highlighted by the administration, U.S. Central Command is having a tremendous effect in degrading the ability of Iran to conduct these attacks. They have destroyed many launchers, command and control sites, coastal radars, but there's a big difference between degrading it and totally eliminating it. It's a small area that we're trying to protect, but the geography from which Iran can launch these attacks is vast. There are many tunnels, there are inlets, it's a tremendous coastline, and some of their weapons, like the one-way attack drones, are relatively easy to produce, relatively cheap, easy to hide, and there are limited signatures associated with their employment until they're actually launched. So to eliminate this capability is an incredibly high bar, and frankly, one that I'd say is impossible to actually achieve.
Yeah, well, how would it be possible when they use asymmetric warfare like fast attack speedboats? Is the administration going after those kind of tools?
Yes, they are, certainly, I think. And we have destroyed most of the Iranian Navy. But as you can see, even with the destruction of the Navy, they still have an ability to impact shipping. When I look at what an adversary can or might do, I actually look at two components. One, what is their will or intent? What do they hope to achieve? And the other is, what is their capability? Now, these strikes have largely been impacting and degrading the capability. But I think they haven't really made a dent in Iran's will and intent to control what's happening in the Straits of Hormuz. They seem intransigent on their insistence that they will control the traffic that goes through. I think one of the core roots of this issue is the MOU that we both signed said that Iran would provide for the safe passage of vessels, but that it would conduct dialogue with Oman on the how this would be administered, and it would do so in accordance with international law. Now, we both signed that. We're clearly interpreting it differently. And these strikes, while they degrade the ability, have not moved the needle on Iran's intent to control the traffic themselves.
After the Interior Minister of Iran's visit to Pakistan, his spokesperson came out and says currently there are no negotiations. It's only possible for there to be an exchange of messages. So what is happening right now in terms of the negotiating table if there's just an exchange of messages? And when you're dealing with Tehran, what's the difference?
Yeah, so I think right now a key challenge is that both sides believe that if they apply additional pressure, they will compel the other to make concessions. And so we are in a period of heightened exchange of strikes and counterstrikes. And I anticipate that's going to continue for some time, perhaps punctuated by periods of pause for diplomatic talks of some kind or exchanges of messages through mediators. But I think that we should be prepared for a period of instability in the region for the foreseeable future.
General, how short are the U.S. ammunition stockpiles right now after the attacks earlier this year, given what the U.S. has sent over to Ukraine and given the ongoing strikes?
Well, certainly there's been an impact on the global supply rate. And I think this is not just a result of this war. Even when I was still in uniform, if we used a lot of munitions in the fight against ISIS in Iraq and Syria, it had impacts on the supply rate across the U.S. military globally. This will be a priority, and I think some of the impact will be lesser munitions for other theaters where we are not actively engaged, to include potentially Ukraine, until the U.S. industrial base is ramped up sufficiently to restock those munitions.
Karen, it's good to catch up with you. This is a major challenge for the American military. General Karen Gibson of Economies Securities. American military superiority is well understood. We can talk about it across a number of dimensions, but the scale of this challenge is particularly unique. You talked about the asymmetric nature of it. These drones they're using, the one-way attack drones, they are cheap to make, they are easy to replace. Then you've got to talk about the environment. This is something that the General was doing just moments ago. The strait at its narrowest point is what, 21 miles, 20 miles, something like that. The coastline is 1,000 miles plus for Iran. So to find and identify the launch sites across Iran, tremendously difficult to do, particularly when you are replenishing your stock continuously in the way the Iranians have done over the last 5 months.
Yeah, and highlighting that is just the fact that Iran has fired ballistic missiles, and supposedly the U.S. had gotten rid of the ballistic missiles. So not only the low-tech drones that they can cheaply produce, but also some of the higher-tech missile ammunition that has not been destroyed. This all highlights how Iran is using the asymmetry to its advantage. They're saying, you have much better technology than us. We'll fight a low-tech war that is much harder for you to defend against. How much is this the road of travel going forward for the likes of Iran, for the likes of Russia in warfare?
And we've got a real-time market measure of how difficult it is to get control. Brent crude right now just off 95, back down to about 94, and higher on the session by 3%, 87 on WTI, and a very quick change. We've added $20 to a barrel of crude in some 3 weeks. Up next, we'll talk about tech. Angelo Zino of CFRA on the high bar for big tech earnings. Live from New York City, you're watching Bloomberg TV. Mag 7 earnings begins. A little bit later on today, you'll hear from Tesla and Alphabet. A week today, you'll hear from Microsoft, Meta. A week tomorrow, you'll hear from Apple and Amazon. And in between, you'll hear from Kevin Walsh, the Fed chair. That's quite a week coming up for this market. Let's start with the equity market. Equity futures this morning on the S&P, the Nasdaq, the Russell declining by a few tenths of 1%, down 0.2 on the S&P. On the Nasdaq this morning, down by 0.5. Not major losses, but struggling to hold on to the gains of yesterday. Chips had a fantastic session, bouncing back some 5%. Adding to Monday's gain and erasing part of that 10% slide on semis through last week. Switch on the board again to the bond market. It gets harder and harder to ignore. 2s, 10s and 30s this morning. Lisa, 2s resetting at 425, 10s at 462.
There is a certain point at which this Federal Reserve cannot ignore the broad-based inflation pressures, even if they are coming from supposedly one-time effects like oil prices. You could see that impatience from the likes of Beth Hammack, but you can also feel that there is something going on in markets. At what point is that just fueled by what's going on in Japan, given the fact that ultimately there is a pressure for the Bank of Japan to take more action? At what point is this a global market where the Bank of Japan has as much effect on the U.S. markets as anything else?
And oil is setting the tone for the Bank of Japan right now. Crude, Brent and WTI, we're elevated. We're pushing higher by 3%, 94 on Brent, WTI around 87. It's a terms of trade shock for the Japanese. It's putting lots of pressure on policymakers around the world. But with dollar yen near 4-decade lows, with dollar yen at 163, talk is cheap. It ain't working anymore. We need to see some action from the Japanese authorities, and that's what the market is beginning to call out.
Yeah, and that's the reason why maybe you're seeing a little bit of a reaction to this news that the Bank of Japan may potentially move faster than every 6 months. Of course, they're coming up against a policy coming from the Prime Minister that is against that, right? The idea of run the economy hot, get the economy far, far away from the 90s, that era of repression, and how much can you get towards some sort of warp speed? Right now, they're really playing a difficult dance. FX very much in focus.
Dollar yen at 163. We're getting some numbers from AT&T. We'll get to those figures in just a moment. In the meantime, let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We are seeing shares of Super Micro soaring 16.5% in the pre-market after the company gave us a preliminary look at its results, and they were excellent, reporting a record backlog of more than $60 billion and that stronger than expected margins. It's also being taken as a sign that customers are looking past recent controversies because the company is still being investigated by U.S. and Taiwan authorities over allegedly shipping AI servers to China containing restricted NVIDIA chips. Staying on that AI theme, we are seeing shares of nuclear stocks, Oklo and X Energy, extending yesterday's gains, rising on our reporting that they will be part of a Trump administration to speed up the development of nuclear reactors used in AI data centers. The program, which also involves the likes of Microsoft and NVIDIA, is the latest reminder of the enormous amount of power needed for AI and that all power sources will be needed. And in the latest sign of trouble for software, we are seeing Pegasystems plunging 15.6% in the pre-market. Its quarterly results missed estimates and highlighted a bigger issue that customers are delaying software purchases because of the rapid change of AI. It echoes what analysts say that it echoes what IBM told us last week, that companies are putting off software decisions in order to pour more of their budgets into AI infrastructure. John.
Yahara, thank you. Thanks for the update. Let's get back to those numbers. The earnings from AT&T just crossing. It's a beat. The stock is higher by close to 5%. Bramo, look at those phone additions, net additions for the 3 months ending June 30.
Yeah, 432,000 versus the estimate of 325,000. So a significant upside beat. This also affecting the share price. The fact that the shares are lower by more than 10% so far this year. They said that they see their full year free cash flow at least $18 billion, and they're accelerating their share repurchases to $10 billion from $8 billion. Given the fact that they also have about $8 billion of dividends, that's the entirety of the free cash flow getting redistributed to shareholders. So potentially that also adding to the boost in shares this
Unlike
morning.
what we're seeing from major tech players who increasingly are doing other things with that money.
Correct, exactly. We're not investing in some sort of long-term project. We've already invested in that. Here you go. Here's your money.
John Stankey coming up a little bit later. The AT&T CEO joining this program later this morning. at 8 a.m. Eastern Time. Do not miss that conversation. A beat from AT&T. The stock is rallying in the pre-market by some 4%. That's our top stock story. Let's get to our top stories in our radar this morning. The Trump administration downplaying the prospect of talks with Iran.
Iran has been reaching out to the United States, both directly and indirectly, to engage in talks about settling the differences. Even though we have reached agreements, they have not kept their commitments. The problem we're having right now is that they're not serious about talks.
U.S. forces attacking Iran for an 11th consecutive day. Tehran telling semi-official media that an exchange of messages is possible, but there are no negotiations underway. Elsewhere, the president threatening a 100% tariff on generic drugs. The president posting on social media that drug makers will have 2 years to move production to the U.S. before the duty takes effect. Levies will rise to 200% a year later. And finally, OpenAI, check this story out, admitting its most advanced models hacked another tech company, the maker of ChatGPT, saying systems for Hugging Face were breached in an unprecedented incident. Hugging Face, which hosts AI models and data sets, reported an intrusion just last week.
And this comes with the latest OpenAI model that they said hadn't had the sufficient guardrails, but they wanted it to really experiment to see what it could do. Again, it just highlights the potential risk here as new models come to the fore. We know that Anthropic worked with the government to try to corral and maybe take offline their Fable and Mythos offerings before you could get some sort of protections. Again, though, this is a huge concern for the financial markets. Yes, this is for particularly an AI company that hosts AI models and data sets. What happens if this really gets into a massive system and shuts it down?
Because it's supposed to be operating in a safe sandbox environment, but the system itself found a vulnerability in that sandbox and escaped to the internet. Now we have Sam Altman, according to the company, going to the White House next week. He's supposed to be going there for meetings. I imagine this is going to be the #1 concern. And potentially the government gets involved the same way we've seen them get involved in Anthropic.
They've got some issues that they need to address. I think an important development in the last 24 hours for that company. 2 additions to the board to OpenAI, both from financial services, one a friend of this program, Robin Vince of BNY. And I think you can think of a bunch of reasons for why this would be happening. I can think of 2. 1, you need financial services know-how to navigate the financial system, not just over the next 12 months for an IPO, but particularly the amount of money that this company is going to need. 1. 2, also PR. When I hear Robin talk about AI and the use case, I hear a quite positive, constructive message about the future, capacity creation, that kind of thing. That's the kind of help I think Sam Altman really needs right now at OpenAI.
He also needs credibility that he can keep control over this until it's ready, and he can keep control over any new models and roll them out in a responsible way. Again, to the point that Robin Vince could potentially create some of the know-how behind this, but with financial systems in particular, clear sensitivity, given what we've seen with Mythos.
That's the latest on OpenAI this morning. Let's get to Alphabet, kicking off big tech earnings after the closing bell. Investors looking for details on spending plans and returns on AI investments. Angelo Zino of CFRA writing, all eyes will be on which companies will be able to win the confidence of investors towards demonstrating successful AI monetization. Angelo joins us now for more. Angelo, welcome. How high is that bar for Alphabet later on this afternoon?
Yeah, I would say, John, Alphabet's probably got the highest bar among the hyperscalers that are out there. The biggest reason is just the fact that, this is a company that's probably been the best, it has been the best performer among the hyperscalers here over the last year. I'd also say when you kind of look at the magnitude of the increases that we've seen across their businesses, whether it be on their ad-related businesses within search or whether it be on the cloud side specifically, those numbers have gone up significantly. You'd have to see a cloud number north of 70% here to really get the street probably excited. And, clearly expectations are for top line growth of north of 20%. So the bar is high here. You kind of look at the multiple here for the shares as well, looking at about 23, 24 times our calendar 26, 27 estimate relative to others that have actually seen their multiples come in significantly. High expectations going into the print.
Angelo, as you know, a focus also on one number, CapEx and CapEx intentions. Help me navigate that. One, are you expecting that number to be bigger? And if it is bigger, is that because they found more things they want to buy, or just that the things they want to buy have got more expensive?
Yeah, I mean, I think the expectation going into this is probably a bias to the upside in terms of boosting that CapEx number. I mean, you're looking, let's say, close to about 190 billion here this year. Whether or not they boost the number here for the second half of this year, I think is less relevant versus what they're going to do into 2027. And in 27, I think, at this point in time, you should expect something at least $300 billion or north of that, just based on kind of what we've seen them do in terms of raising equity. Also, when you kind of think about what they've seen here over the last couple of months in terms of that cloud growth, you need to continue to invest aggressively. And I think as long as you can kind of show that the magnitude of the backlog growth that we've seen here over the last couple of months, they've essentially doubled the backlog growth last quarter. We'll see what they do here this quarter. As long as they show that growth trajectory, and they are going to start ramping up the hardware-related revenue here in the second half of this year, I think the street will be okay with the higher CapEx numbers, but in kind of moderate levels here.
Wait, hold on a second, Angelo. I want to make sure I'm understanding what you're saying. You think that it's enough for them to show the backlog of business, the demand for services that they're building out and they're investing in, and that will be enough, even though they continue to come out and say, demand outstrips supply dramatically again and again. We have seen some fading credibility that markets say, okay, maybe, but that's not enough for us. You're saying it still will be enough.
I think these companies are going to be looked at on a case-by-case basis. And when you think about Alphabet, or if you kind of look at how the market has kind of reacted to Alphabet here over the last couple of quarters, I think they trust Alphabet a lot more than I'd say some of the other hyperscalers out there in terms of being able to monetize and take share, at least on the cloud side of things. So I think when we kind of look at the pipeline here from Alphabet, and I also think when you kind of look at what they've also done on the ad side of things in terms of accelerating that growth, again, we've got to see what the numbers look like and what what kind of clarity they provide here into the second half of this year. But I think it'll be enough in terms of if we continue to get that momentum on the booking side of things.
Angelo, will Google's gain be everybody else's pain? And I'm talking about cloud computing and winning share. We've seen that in the past. A question of whether Google Cloud wins at the expense of AWS and Azure. Do you expect to see that type of dynamic, or do you think that a rising tide can still lift all boats?
I think you're at a point where you can see the rising tide lift all boats. I just don't think it'll be kind of at the same trajectory, across these companies. So for Alphabet, I'd say that tide is much greater. Just kind of based on what they've done here, I'd say it's a lot less. The visibility is a lot less there when you think about Microsoft, and clearly the multiples show you that in the stocks between the two companies. And then of course, when you start looking at some of these tier two players, right, you think about what Oracle is having to go through right now. I think that's really the problem child in this market. But and then you kind of throw all that into what Meta's doing at this point in time, and I think that's really fascinating in the sense that they're kind of ramping up this compute offering. We'll see if they announce anything in terms of a potential kind of bookings or growth trajectory in terms of that AI compute business, because I think that's really important in terms of some of the tier two players that are out there, and that potentially impacting the backlog growth you'll see from those companies in the coming quarters.
We also have Tesla on deck. Does the earnings take on increased importance since the SpaceX IPO and all this speculation that potentially there could be a tie-up between the two?
Yeah, I mean, I think you'll definitely get asked that on the call as far as Tesla is concerned. I think there's an expectation or growing expectation by many out there that there is going to be a combination from the two. But yeah, I think it's going to be an item up for debate here on the call. I don't think Musk will directly answer that one, but I think there's going to be, especially after the call, there'll probably be more speculation around it from the investment community.
Angelo, thank you, buddy. Appreciate it. Angelo Zino of CFRA. We'll be talking about Tesla a little bit later on this morning. It will be the only question, be the first question for so many people. Just when's it going to happen? Yeah. When are you going to see this tie between them and SpaceX?
Yeah, and what's the market kind of forecasting here? I mean, in other words, if they don't get some sort of announcement, then does that disappoint shares and does it send them lower, or is everybody going to keep out hope that maybe it'll be next quarter?
Nasdaq futures this morning down by 0.6%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump approving an agreement with Saudi Arabia to develop a civilian nuclear program. The Wall Street Journal reporting the deal could pave the way for uranium enrichment inside the kingdom. The 30-year agreement is estimated to be worth tens of billions of dollars. AT&T shares rising in the pre-market. The company reporting second quarter earnings that beat analyst estimates. AT&T also seeing its quarterly revenue tick up as more customers sign up for its postpaid phone and internet services. And coming up at 8 a.m., AT&T CEO John Stankey joins Surveillance. The World Cup final scoring a record US TV audience of more than 62 million viewers. The tournament's viewership more than doubling compared with 4 years ago. And the official FIFA TikTok account receiving more than 24 billion views throughout the tournament. That's your Bloomberg Brief. John.
Bonnie, thank you. It's a great time for good news because guess what? The bidding process will start soon for the next round of the World Cup and the round after that. And there is talk, the number I've seen, of something like $4 billion for the US rights. It's a multiple of what Fox and Telemundo have paid for the previous World Cup bidding auction. And we could see other names like Netflix, YouTube, Disney maybe get in the mix to pursue this.
Increasingly, it's not a revenue driver when it comes to a lot of these different streaming platforms and cable networks, just because the costs are so high. The goal is just to attract viewers, because ultimately that is what you're paying a premium for, but the costs are high enough to offset all the other potential revenue gains.
Get more content though, Bramo. Just make it a 100-team series, you know? Just have 100 nations in it. We'll do this the whole summer, 3 months.
And you know what? They could be split with Paramount, Netflix. You could have to go to each one to see the different teams go, because that's what they're doing currently with sports.
Look, I'm joking, because right now I've got withdrawal. I miss Portugal, Uzbekistan. Like, I miss those games. I want to go home and it's not there.
There's nothing really good on right now.
I don't think
you're
watch the Yankees. You're not being serious.
I am deadly serious.
You know, you're already thinking about golf.
Premier League's a few weeks away.
Exactly. Carry on.
August 21st?
A few weeks away. OK. Up next on the programme, inflation fears driving higher.
When we look at the drivers of inflation, they all suggest upside risks to inflation pressures. Inflation is not going to move back down to the Fed's target without additional policy tightening. The bar for hikes is relatively low.
Up next, we'll catch up with Subadra Rajappa of SocGen, live from New York City. You're watching Bloomberg Surveillance. We're down 0.2% on the S&P. We're down 0.5 on the Nasdaq 100. Some outperformance on the Russell relative to the Nasdaq in a down market. We're down by only 0.25% so far on the small caps. Into the bond market we go, where yields are really elevated. Look at this, 425 on twos, 462 on tens, a 30-year around 513, the upper end of the recent range, very close to the very upper end of the recent range on yields across the curve. The move in crude's not helping. WTI and Brent, another move this morning of 3 to 4%. Here we are this morning, just off 95. 95 earlier, down to 94 on Brent. WTI at 87, a week out from the Fed's next meeting. Under surveillance this morning, inflation fears driving inflation much higher.
When we look at the drivers of inflation, they all suggest upside risks to inflation pressures. Inflation is not going to move back down to the Fed's target without additional policy tightening. The bar for hikes is relatively low. We think the first hike is going to be in September, and you'll have a sequence of 3 rate hikes in the back part of this year.
So here's the latest this morning. Rising oil prices renewing inflation fears, with the Federal Reserve July interest rate decision only 1 week away. Treasury yields hovering near highs of the year, putting last week's call inflation prints very much in the rearview mirror. Subadra Rajappa of SocGen writing, while we continue to expect the Fed to keep policy on hold, persistent market pricing reinforces the possibility of a hike by the end of the year, likely after the midterm. Subadra joins us now for more. Subadra, good morning.
Good morning.
Let's start with the base case. Base case for you is a hold. So let's start with why. Why a hold?
Only because of the fact that we thought that so far the data has not sent a clear signal that the Fed should hike immediately. And then you have the dynamics with the midterms and Kevin Walsh taking his job. Just a month ago, he probably doesn't want to come in and raise rates as soon as he's been appointed as chair. So those were kind of some of the motivations. And then you got the two softer, the CPI prints, the PPI prints. Core PCE is probably going to be, also somewhat on the softer side. We're expecting 0.18 for, month over month. So that brings core PCE at 3.3%. So there's not an urgency for the Fed to hike, but the market is fully pricing in a hike by the end of the year. So at some point, the market's going to dictate to the Fed what the Fed should do. If the market is fully priced for a hike and the Fed doesn't deliver, then the Fed's going to be inducing volatility. So that's kind of the spot that we're trying to navigate here.
Can you unpack the move in yields in the U.S.? How much is oil? How much is the Bank of Japan? How much is just deficit concerns as we keep hearing about the mounting bills from the conflict in the Middle East?
So when we wrote our mid-year outlook, I thought maybe the conflict was almost over. The Iran war is fully back on. You have higher oil prices. You're looking at the impact of higher oil prices kind of feeding through to all of the other economies in the world. Europe and Japan are extremely impacted by that. So you're starting to see those economies start to, markets I should say, start to price in more hikes and higher yields. And then you're seeing the rout in the yen. Inflation expectations in the US have been somewhat contained, but I am concerned about the trajectory for debt and deficits. The Trump administration's asked for $87 billion extra in supplemental funding for the war, as well as for the farm bill. And you're looking at refunds from IEPA also contributing to higher deficits in the month of June. So all of that put together, you have a dynamic where you have not only higher inflation, but investors are starting to get a little bit concerned about the trajectory for debt and deficits.
And the best evidence for this is real yields, because you're seeing that right now yields are not climbing higher as a result of inflation expectations. They're actually relatively muted. But you are seeing real yields on U.S. 10-year Treasuries reaching the highest levels since 2023, 2.34%. How high do you see that getting if the Fed does not hike rates, if the Fed remains on hold despite what the market seems to be suggesting?
So, I mean, we are near the highs. Is it possible for real yields to push higher? Yes. You're starting to see some of the correlations that you typically see between gold and real yields start to come back in play. That inverse relationship is starting to come back into the front. Typically, investors start to buy or enter into the bond market when real yields look attractive and move away from gold. But I don't know if you're going to see that backstop bid in an environment where the concern is for debt and deficits. And debt and deficits is not just a U.S. problem. You're seeing this in Europe as well as in Japan. And that's really where I think the global bond market dynamic starts to come into play and push yields higher.
What's the window the Fed has to act when the market actually continues to believe them and it's not just empty threats, given the fact that the market's pricing in hikes and officials continuously talk about how they're concerned about higher inflation?
So historically, if it's like 70-80% priced into the market, the Fed typically tends to deliver. We saw a lot of volatility in the July meeting pricing, right? I mean, we went from almost being fully priced in early last week to not being priced in to now yesterday. You start to see that come back into play. That's one of the reasons why I highlighted that maybe the Fed might have to act by the end of the year, because it's more than fully priced in for the end of the year. It's a question of whether they deliver before the midterms or after the midterms.
Do we need to rethink that when we say things like typically, they usually? Is this a different Fed where typically and usually doesn't really apply anymore?
100%, and that's what makes it all the more confusing, because there's no forward guidance. I mean, this is not, business as usual for the Fed. And it's hard to know if kind of the market's going to dictate to the Fed and the Fed is going to ignore the market's pricing. But, as I pointed out earlier, I think that typically tends to lead to volatility when the Fed doesn't follow through on market expectations. So the Fed has to decide if they want to comply or be the inducer of volatility in the market.
Subadra, it's good to see you. Appreciate your time, as always. Subadra Rajappa there of SocGen. We'll catch up with Mike McKee later to try and get confirmation as to whether we'll get a news conference or not a week today from this Federal Reserve. Up next, we'll catch up with Meera Pandit of JPMorgan Asset Management, Libby Cantrill of Pimco, Susan Bell of Rystad Energy, and Simona Mocuta of State Street. The second hour of Bloomberg Surveillance just around the corner.
The U.S. economy continues to chug along.
It's all fun and games until the Fed has to pump the brakes.
Hawkishness at the Fed is reaching a type of critical mass.
I'm hard-pressed to see Fed tightening. We have a labor market that's stable.
I think the Fed is going to be on hold through the rest of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this, declining following yesterday's bounce. On the S&P, we're down by 0.2. On the Nasdaq, down by 0.6. In the bond market, new levels again to talk about. 426 on 2s, 463 on 10s. Responsible for this, somewhat, what's happening with the crude market right now. Brent earlier topping $95 a barrel for the first time in 6 weeks. This morning, as things stand, higher by close to 4% at $94.35.
Yeah, and this is a global story, and we've been talking about it all morning, how higher oil prices don't necessarily translate to higher inflation in the U.S., and certainly you're not seeing that in inflation expectations. That said, around the world, it is pressuring a lot of nations, whether it's in Europe, when we get the ECB rate decision tomorrow, whether it's in Japan, where you're seeing some real pressure on the currency. Given that, you start to wonder at what point the bond market diverges from some of the past principles and rates keep rising, despite the fact that people still want to use the T word when it comes to some of these inflationary inputs.
And I know when Jonathan says the market just wants, or investors just want to ignore where Brent is this morning at $95, you can't. Even if you decide to ignore the rhetoric coming out of Tehran and Washington, you can't ignore what's actually happening. 11-day, another straight day of strikes, finishing last night. We're getting messages now that the Iranians are talking about what they've been targeting, U.S. air bases in Jordan, desalination plants in Kuwait. All of this continues, and at the same time, the Houthis are just threatening to get involved, and already that is diverting some ships.
This is up there with tariffs, two of the most hated stories in financial markets. It really is. Tariffs and this in the Middle East. And why? Because they didn't matter to the market. That the market kept rallying up and to the right, up and to the right. We saw through the issues with tariffs, everyone got worried about it, wasn't a problem. We saw through the issues in the Middle East, everyone got worried about it, wasn't a problem. That's what makes this moment so dangerous in the Middle East, because people have been scarred and conditioned by their experience over the last few months not to be too preoccupied by all of this, to focus on what's happening elsewhere. And yet the risk continues to build, and the cushion that's insulated us all is getting smaller and smaller. And that's where the worry comes this time around.
The inventories have been drawn down significantly, and it's not just on Brent crude and WTI. It's also on refined assets, the distillates, which have also gotten to near record lows. And you're seeing that in terms of the spread for heating gas and gasoline and just natural gas even over in Europe rise to really high levels relative to where the base commodity is. And that's leading to a lot of people to wonder how much this is going to bleed into consumer activity. It's also, we cannot predict this story. It is out of our control. And the stories that you can predict are becoming less predictable. And that is the tech story. So all of the pillars that are keeping up this market kind of facing their own questions right now.
The other comfort blanket, the earnings, of course. The earnings have been absolutely fantastic, tremendous. And later on, we get more earnings. We will hear from Tesla. You will hear from Google, Alphabet, of course. And you will hear from IBM. This morning, we heard from AT&T. And again, a different company, another sector, really good earnings from that company this morning.
Yeah, adding a much higher number of subscribers than people had expected, but competing on price and actually offering discounts to lure people in, emphasizing that they want more subscribers rather than getting the best bang for your buck with every single one of them. So how much is this strategy of hoovering up enough of the pie ahead of broader AI adoption, broader connectivity? Does this give a read that is secular, structural? I mean, what can we read into this to extrapolate a larger narrative?
John Stankey, the CEO, joining the program 60 minutes from now. Coming up this hour, we'll catch up with Meera Pandit at JPMorgan, ahead of a key week for big tech earnings. Libby Cantrill of Pimco, with President Trump threatening a 100% tariff on generic drug imports. And Susan Bell of Rystad Energy as crude spikes following an 11th straight day of attacks against Iran. We begin this hour with stocks failing to maintain momentum, heading into a massive stretch for earnings. Meera Pandit of JPMorgan Asset Management writing, the AI narrative is one of stagnation and rotation. Earnings growth may not be the decisive differentiator. Joining us now, Meera Pandit. Meera, it's good to see you.
Good to see you too.
Let's get to this bar. We've talked about it so many times. It's really, really high. We were shocked by a positive earnings surprise through the first quarter. How difficult is it to repeat the act in Q2?
We are no longer talking about whether AI is a bubble or not. It's very much become this volatile trade around stagnation in areas like the Mag 7 and the hyperscalers. Mag 7 are barely up this year, up slightly. Hyperscalers slightly down, to this rotation into semis. And what we're also seeing is this rotation back and forth. People want a little safety, they go to the hyperscalers. People want a little growth, they go to the semis. And so this trade-off has been persistent over the last couple of weeks. But then you think about these spectacular earnings and the earnings growth that we're seeing out of these companies, nothing has changed from that perspective. Still incredibly impressive. But the challenge is the Mag 7 years ago had set such a high bar of trumping themselves each and every time and every quarter that your reward for that upside in earnings was only taken away from the fact that your upside in CapEx kept increasing. And you're even seeing that now with the semis, where some really explosive earnings globally in different semi stocks have not necessarily impressed the market. So that bar, again, has become so much more challenging for rewards here.
Are there areas of the market that make you a little bit more constructive when you think about the prospect of being rewarded, these earnings coming through strong and being rewarded in the equity market?
I would say probably financials, although I know that there is an AI stripe to that when you think about the fundraising there and the IPOs, capital markets activity. That was clearly a big driver when we think about earnings this past quarter. But underneath that, you still are seeing very strong consumer fundamentals when you think about delinquencies and charge-offs. You're still seeing loan growth there. So it's not masking any weakness there. There's still some underlying strength. And that has been a laggard for most of the year until recent weeks where you've seen that start to pick up. But the big challenge we're facing as investors is when you go to those traditional spots for diversification, when you go to value, when you go to small cap, those are very AI-centric still. I mean, you look at where we are year to date, and it's been so shocking to see how much value has outperformed growth persistently throughout the year. It's not really an energy story. A lot of energy gains have been given up since the pre-war time frame, but it's really 51% of that return coming from just 10 stocks that are all semis, hardware, equipment. And 7 of those stocks will not actually exist in the value indice after the rebalance. You see the same thing with small cap. It's a bit of a confluence of low quality rally, of reversion to the mean, but also that AI trade where if you looked at the second quarter, 22 of the 25 top performers were also AI related, about 30% of the return. You look internationally, you see earnings growth, 60% of that being driven in Japan by AI, 80% in emerging markets. So it's so hard to go to some of those typical spots, which is why it's so important to say, let's look at the company by company fundamentals here to find some diversification.
Max Kettner was on earlier from HSBC, and he has been max bullish. And as John was saying, we all look for, I still remain bullish even after all of his negativity. This time he was a little bit different. He's saying this will be a true test, the way that the market responds to tech earnings that we get later this week and into next. Do you agree? Do you think that if stocks sell off, even in the face of good earnings, that's a broader sell signal to get bearish on U.S. equities?
It's just been so touch and go around the tech story that it's hard to get truly bearish around it because then investors find another place where there's opportunity and potential growth. Again, as this trade continues to rotate into new favorites and then back to old favorites, I think the bigger risk here is more around investor fatigue and more of, again, that stagnation risk that things don't necessarily crater, but instead investors just say a lot of this is in the price given what we've seen over the last couple of years.
How high do yields have to go for bonds to be a competitive pressure with respect to AI versus income?
As you mentioned earlier, that real yields are showing some of their best levels in years. So I think it is a competitive pressure in that it gives you another source of diversification. You have to be a little bit mindful in that within the IG space, there's a lot of tech there. But I think for it to become a threat to equities itself, you'd have to see more of an acceleration in yields as opposed to what the absolute level is. If things grind a little bit higher, I think we're still okay. And it's not necessarily grinding higher all for bad reasons. Yes, oil is a component and inflation pressures are a component here, but the economy is still fundamentally in a good place. And I think what the Fed is arguing is there is this geopolitical and inflation-prone economy that we are mindful of, but there's also a resiliency to the economy where we just may not have rates that are restrictive enough to an otherwise pretty solid backdrop.
You don't think the Fed moves until after the midterm elections, but does that match the rhetoric you're hearing from Fed officials?
It doesn't necessarily match the rhetoric, and we've seen a big pivot here. I mean, it's so surprising to think about when Kevin Warsh was first nominated, we were telling clients we don't think he'll cut rates in a massive way, and now instead it's we don't think we'll have massive hikes. The rest of the committee's composition hasn't fundamentally changed much. And if you look at the dots in the dot plot, for example, you still had 8 people on hold this year. Again, we don't know who's a voting member and who's not necessarily, but if you look at that trajectory of the dot plot, it almost looks like a little bit of a hike and then a cut. So to me, that suggests a hold because you probably won't just see one rate hike. And I think if we think about the July meeting, probably a little bit premature, even though the rhetoric has been strong. September, typically you see movement before the election only if there's already been a chain of movement, cut or hike. So perhaps the first live meeting, again, is likely December. But even then, we do see broader disinflationary pressures in shelter when you look at rental vacancies, in wage growth helping services potentially. So there are a number of different areas, even tariffs, although they're resurfacing, probably a lower rate than what we were at last year. So we could very well see that timeline pushed out further into 2027.
Let's try not to talk about tariffs, Meera. We're really trying to bury that story. We'll talk about it in a moment. It's hike versus hold. There are some out there that believe we'll get cuts. Citi's still holding on to that call. This came from Andrew Honhorst just moments ago. Andrew and the team over at Citi. The yields are basically following energy prices higher. But, and it's a big but for them, we think markets are underappreciating the extent to which softer CPI will raise the bar for Fed hikes.
Yeah, and this idea that we did get those softer CPI and PPI levels, given that Andrew Honhorst and the team thinks that there is greater weakness in the underlying economy and that will actually pressure people to still cut. I think they removed the easing bias and we left because we already had seen such hawkish rhetoric. I think Citi is pretty idiosyncratic in their call.
Unique.
Unique, thank you. That's the word I was looking for.
For sure.
Yes,
for
exactly.
Sure. Meera, let's finish on this. How high is the bar? Is the bar higher for hikes or higher for cuts for the year ahead, as far as you and the team are concerned?
Right now, the bar does seem higher for cuts, given the shift of the rhetoric and given the fact that just the totality of history over the last couple of years where we have seen inflation overshoot. And now that the markets have priced in those hikes, it feels like getting back to an environment of cuts is going to be a little bit more challenging. But again, it's very possible from an inflationary perspective where we start to see things come down more than perhaps expected next year, irrespective of energy, again, pointing to some of the things I had just mentioned around wages and I won't say the word again, starts with a T.
I'll do it in a minute, don't worry.
So there are certainly some balanced risks around inflation in 2027, but at the moment where the market narrative lies, it seems like the bar to cut it is pretty high.
Meera, thank you. Meera Pandit of JPMorgan Asset Management. It's tariffs on the Strait of Hormuz, and people are just like, no, I can't hear you.
Tariffs, transitory,
right.
Other T words that just, honestly, people just, how do you price that?
With difficulty.
Which is the
and
reason
even when you price it in the crude market, you still try and ignore it because of how things have played out in the last 5 months. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump minimising the prospect of immediate talks with Iran as the two sides exchanged strikes for an 11th straight day.
I will tell you, they want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest in even.
Iran confirming mediators reached out with proposals to ease hostilities. Intel confirming a new round of job cuts to reduce costs as part of its turnaround effort. The layoffs will target the company's data center business, which has been helping drive a recovery in revenue amid strong demand for AI infrastructure. Intel reports earnings after the close tomorrow. Apple is partnering with shopping and payments platform Klarna to launch a new leasing program. Sources telling us here at Bloomberg, the service will work like a subscription model, allowing customers to pay monthly for iPhones, Macs, iPads and Apple Watches. And that is your Bloomberg brief, John.
Hey, Vonnie, thank you. Appreciate the update. More from Vonnie in 30 minutes' time. Up next on the programme, putting tariffs back on the agenda.
We have a very big plan on pharmaceuticals. We want to bring a lot of the pharmaceuticals back to America where they should be. We're going to want to be making a lot of them ourselves, all of them in a sense.
Libby Cantrill in the green room. I'm not sure even Libby wants to talk about tariffs, but we'll attempt to get Libby to talk about tariffs in just a moment. Libby Cantrill of Pimco, up next. Equity softer, down by a third this morning on the S&P. Bouncing back yesterday, raising some of that gain this morning on the Nasdaq 100, down by 0.7. We managed to squeeze out decent days of gains for the S&P and the Nasdaq, even with the repricing across the yield curve yesterday. 2s, 10s and 30s. Yields up throughout the last 24 hours across the curve. 2s around 426, 10s around 463. Supporting that move, this move in crude, higher by 3 to 4% so far this morning. Crude at 94.40. WTI 87.30. Under surveillance this morning, we've got to talk about it. Putting tariffs back on the agenda.
We'll be announcing on pharmaceuticals sometime in the very near future. We have a very big plan on pharmaceuticals. We want to bring a lot of the pharmaceuticals back to America where they should be. We're going to want to be making a lot of them ourselves, all of them in a sense.
So here's the latest this morning. The president saying generic drug makers will face a 100% tariff if they do not move production to the US. The president posting on social media the duties will take effect in 2 years' time. Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, as you're saying, President Trump says that this is part of the administration's effort to onshore manufacturing, but it is raising questions on the potential impact it will have on the cost consumers pay for generics, which make up nearly 90% of U.S. prescriptions. If this sounds familiar, you'd be right, because back in April, the U.S. Commerce Department announced the results of that Section 232 investigation looking into the national security implications of making pharmaceuticals abroad, and at the time announced that the U.S. would levy brand name pharmaceuticals at a 100% tariff, actually by the end of this month. But this is the first time that we've gotten an update when it comes to generics. Now, publicly, the administration has billed this as part of its affordability push, launching alongside it a direct-to-consumer discount drug sales platform. But the planned tariffs are expected to raise costs on manufacturers that are already operating on thin margins, risking higher prices. Now, John, our own analysts at Bloomberg Economics say we'll have to wait to see exactly how big an impact this will have, in part because the administration has granted carve-outs to some of the biggest companies like Eli Lilly and Merck, who have committed to building factories in the U.S. Plus, keep in mind, levies on exports from some countries that have struck trade deals with the U.S. could face lower rates.
Tyler Kettner with the latest in Washington. Unfortunately, we've got to build on this. If you don't like this story, I haven't got good news for you. Later this week, on Friday, we've got a deadline approaching for President Donald Trump's global tariffs. Sources telling us here at Bloomberg the administration is planning fresh levies in the coming days to keep those levels intact. Libby Cantrill of Pimco writing, while some speculated that Trump might soften his stance, we're likely to see him once again double down on higher tariffs. Libby joins us now for more. Libby, good morning.
Thanks
for doing this.
I also don't want to be talking about tariffs, by the way, but I'm happy to be talking with you.
Why is Friday so important?
So just as a reminder, about half of the tariffs that the president had put on were ruled illegal under this SCOTUS ruling in February. That was under IEEPA, the International Emergency Economic Powers Act. The president then replaced those tariffs with this sort of temporary stopgap law, Section 122, at 10% across the board. Those expire, though, on Friday. So our expectation is that he would, even before the reporting, is that he would then move forward with more tariffs under these more durable tariff tools, Section 301, Section 232, now Section 338 is in the mix. That comes from a 1930 tariff law that has actually never been used before to impose tariffs. So I think that the point here is that even though I think there was maybe some hope among some folks that he would use this opportunity to sort of pivot away from tariffs to maybe take some of these concerns to heart in terms of affordability and concerns of voters going into the midterms. He's not. And I mean, our expectation was that he would not. He believes in tariffs. He thinks tariffs work. And importantly, from a revenue perspective, tariffs are a tax. They do raise revenue. And so what this administration is trying to do, I think to also maybe quell the bond market a little bit, is to reconstitute that tariff rate to get back to that sort of $170 billion amount that we were raising under tariffs, under IEEPA and the other provisions.
But as you mentioned, some of these legal authorities have never been used before. So what are the chances we're back at the Supreme Court?
Well, so Section 301 is more durable. That is, there's a lot, as you know, a lot of process that's required there. There's an investigation, there's public comment. I would be surprised if these new tariffs that are likely to be announced on Friday under Section 301 would be contested by the courts. We'll see. The Section 338, much more novel use, again, has never been used under the 1930 Tariff Act. We'll see. It's the way that they're imposing them. It is very targeted on those products that Canada discriminated against or allegedly discriminated against, things like alcohol, and they're more targeted. So we'll see. They might be actually more legally durable. But I think the bottom line here for markets is that even though we wanted this sort of this tariff trade policy risk to be in the rearview mirror, it once again continues to be, I think, front and center, honestly, for this president. He believes this. He believes this is unfinished business from his first administration. He's going to continue to focus on it.
What about this latest threat when it comes to generic drugs? If you talk to analysts, 100%, 200% tariff on generic drugs actually doesn't even mean it's going to be cheaper to produce in the United States. You'd rather take the hit on the tariff and still produce in India or in China. Is this just a midterm election message?
I mean, it definitely, I think it's one of those talking points the president likes to lean into in terms of decreasing, drug prices. I mean, look, the time frame is not until August of 2028 That, of course, is right before a presidential election. It all of this feels, I think we should believe it when we see it. But I think the broader point here is that while this might be the news of the day, the bigger, broader headline is that the president is going to continue to move forward with these other tariffs. And again, in order to rebuild, to get to that kind of 13% effective tariff rate that we were at in the January before the SCOTUS ruling in February.
Why do we hate talking about this so much? Is it just that we think that this is all going to get overturned or that it's not going to go into effect? So any analysis that you do of it's just going to be wasted breath?
Well, a little bit. And I think what we have seen is that the economy has been able to absorb tariffs much better than I think we were all expecting. One was that the other countries really didn't retaliate against the United States. I think that was actually something that I think we all sort of assumed, and that did not necessarily materialize. And then obviously the president has also backed off from sort of the apex of the Liberation Day tariff. So we have not, we sort of touched the hot stove and he retreated.
You said something, though, fascinating, which is the bond market is watching the deficit climb. And they're watching the fact that there aren't the revenues coming from the tariffs that were overturned by the Supreme Court. And they're watching what's happening with the conflict in the Middle East. And they're watching what's happened with Doge and some of the people who've been added back. And they're wondering, how is this going to add up? At what point is that the big market takeaway that needs to be the focus?
Yeah, and then, you obviously have this sort of supplemental request for an additional, $90 billion or so, in addition to what was outside of the appropriations process, obviously just meaning the deficits are going to be higher here. So the bond market, has been relatively sanguine about the government's finances. I think there's a lot of dynamics there. One is just the fact that the yields have been attractive, so that's attracted maybe some more economic buyers, some more foreign investors that have replaced some of those central bank reserve managers who used to buy treasuries quite a bit. But I think there's also sort of this expectation that yields will be higher, that the yield curve will be steeper, and you've obviously sort of seen that play out. So our view here is that deficits continue to be high. They continue to be the biggest loser in terms of the political situation in Washington. Both parties have a spending problem. Both parties don't really want to raise taxes. And so, there will likely be a reckoning. Is that a bond market reckoning? Or, and I think even more likely, is that a policy inflection point? One thing just to, we've nerded out about this before, but the Social Security Trust Fund is going to go bankrupt in 2031. That means it starts paying out less than it brings in. Why is that important? That is politically untenable for members of Congress to absorb. So there's going to have to be something. I think this might become an issue in the 2028 general election. So anyway, I think that the music, as long as the music is playing, members of Congress will keep dancing, the bond market will keep dancing, but it does feel like there will be some sort of reckoning. Again, whether that's a bond market reckoning, that seems sort of less likely, just given sort of the dynamics. It could be a policy inflection reckoning.
Libby, you're the best. Appreciate it. Thank you.
Thanks, guys.
You were great. Libby Cantrill at Pimco, thank you very much. That's the situation right now with the Treasury. The problem that we all have with politicians is they're not really known for preemptive solutions. You need a crisis before you get a solution. 420, 460, 5% across the yield curve. It ain't it. It is not it.
It might be when people start to get less from Social Security than they pay out. That might be the reckoning that they need.
Futures this morning, down by a third. Up next, we'll talk about energy with Susan Bell of Rystad Energy. Stocks down following the biggest one-day rally of the month so far in yesterday's session. Equities down by a third on the S&P. Yesterday, the rebound driven by chips. Chips entering day two of a rally following a 20% plus decline from the highs of June and a 10% slide through last week alone. Chips doing a bit better. We're taking some of it back this morning in the equity market. In the bond market, the picture looks like this. 2s, 10s and 30s. Two-year yields basically back to where they were before CPI came out softer than expected, closing in on 430 at the front end of the curve and taking it all back almost on 2s following softer CPI and PPI. Going into the Fed's next meeting a week today, the setup yields close to the high of the year. In the bond market, yields are higher. Crude in the energy market higher as well by 3 to 4%. WTI this morning close to 87.40. Brent crude briefly earlier this morning topping 95 for the first time in 6 weeks.
And these stories are related. The softer than expected CPI and PPI was really due to oil prices coming down as people expected some sort of resolution or at least a truce to hold. Now, as that unwinds, people are saying that's backward looking. This could potentially increase the inputs to a lot of PPI and CPI. It's also being driven by other places, though, as well. But either way, it's a boiling the frog type of moment. Just one day after another, the story doesn't go away. And that's the reason why you're seeing just markets slowly adjusting.
Even if you want to ignore it,
you can't.
You can't. You know, blink and you missed it. 2-3 weeks ago, we were in the low 70s on Brent, in the 60s on WTI. We've added $20 to the price of crude just like that. I get it in Wall Street. You're dealing with some of the most impatient people on the planet. I get it. I don't hate it. I love you all. And they don't want to waste time. And they've wasted their time on this story for 2-3 months. And it wasn't material. So who should you listen to now when so many people got it wrong? I think Barclays. I think of Ajay Rajadaksha, Vinu Krishna, who got the rally right, ignored the initial stress in energy, and then came out a little bit later on following that massive run-up in chip stocks and said, now we're starting to get a bit more concerned. Because it's not that we didn't think it mattered in the Middle East, we just didn't think it mattered yet, because we had a massive cushion of inventories, but that cushion is getting thinner and thinner, and these problems keep persisting.
That was the sort of break point that people were talking about when you hit tank bottoms. Are we get that much closer? Yes. Are we going to get there? That's ultimately the question. And it's not just tank bottoms when it comes to crude and WTI. It is tank bottoms when it comes to natural gas. It is crude bottoms when it comes to other distillates like heating oil. You're seeing those also go down, and that might be harder to replace.
And that's what we've heard from Jeff Curry. That's what we heard from Francisco Blanche yesterday of Bank of America. Don't even bother with Brent WTI. You need to look at actual product. And it's not just the conflict. And we spoke about this. Yeah, so China's been a little bit softer on crude imports, but they are hoarding products, diesel, gasoline. What is going on right now in Russia? They have an export ban on diesel because they have a crisis internally in their country. There are a lot of issues right now in the world when it comes to product. And that's why you're seeing gasoline in the United States continuously above $4 a gallon.
Love Francisco. Love what he did. Do you see what he did? Came over to the US, pretended he'd got meetings. He went to the Spain game. Watch the final on Sunday.
Epic.
Right.
Can we all have his life? That's fantastic. He admitted that to you?
Yeah.
Oh, we talked about it. Bragging rights
sure he
for
squeezed in some meetings as well.
But bragging rights for 4 years. Can you imagine?
Brian, what do you think about that?
Yeah, it's worth the money if you can brag for 4 years.
He said it was pre-scheduled, just for the record.
And just for the record, the Bank of America did sponsor the whole event, so there is that.
Well, no, he extended his trip.
That's right.
So he planned the meetings. Actually, he did this very well.
Before we get Francisco in trouble.
Yeah.
Please clarify.
Yes, it was a scheduled trip before the World Cup.
Okay.
Spain made it. And then he extended, and then he joined our program. So it was a win-win.
It's well worth the extension just to join this program, of course. Yes. Count you down to the opening bout. 2 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Well, we start with Intel here, giving back some of yesterday's gains as the broader chip sector takes a breather. Those shares down 3% in the pre-market, but it rallied some 8% yesterday after the company confirmed another round of job cuts in its data center business. This all part of CEO Lip-Bu Tan's turnaround plan, which has involved job cuts and cost-cutting measures. And investors will get a better look tomorrow at whether that strategy is paying off when this name reports earnings after the bell. Let's get to the earnings that we've gotten this morning, and we start with GE Vernova. Shares are down 5.5%, even after it raised its full-year outlook as the company continues to benefit from the AI power build-out. But investors are focusing on margins that came in just a touch lighter than expected. Plus, the bar was incredibly high for this name, which is up about 60% year to date. And we end on AT&T. Shares are rising nearly 4% in the pre-market after it added 432,000 monthly wireless subscribers. That is more than 100,000 than the street was expecting. The results are helping to ease concerns that have been hanging over the stock, which is down 10% year to date. It's navigating an increasingly competitive environment, not just because of the likes of Verizon and T-Mobile, but also amid growing speculation that SpaceX might get into the wireless business as well. That is something to ask John Stankey, the CEO, when he joins you all at 8 a.m. Eastern today. John?
No doubt, Yahara, it will be part of the conversation in 30 minutes' time. Bramo, it's a big piece of the conversation. Do you see Starlink as a competitor in the future, a partner? Maybe, I don't know. What does that relationship look like in years to come?
Yeah, and how does the competitive landscape change as you've got satellite increasingly getting into the otherwise wireless and fiber universe, a changing environment for a lot of different businesses?
John Stankey coming up from AT&T. 8 a.m. Eastern Time. On our radar this morning, the Trump administration reportedly preparing to launch new tariffs on products from dozens of countries. Sources telling Bloomberg the levies would hit 60 nations, with rates starting at 10% starting this Friday. Elsewhere, the Trump administration continuing to downplay talks with Iran.
We remain open to diplomacy. We remain open to working it out in a negotiated way. But right now, they don't seem to be serious about that. And so we're going to continue to protect shipping. At the same time, we are going to, when the opportunity presents itself, degrade their ability to target global shipping.
Iran insisting it should maintain control of the Strait of Hormuz and calling on its Houthi allies in Yemen to disrupt shipping traffic through the Red Sea. And finally, Bank of Japan officials open to raising interest rates at a faster pace than expected. Sources telling us here at Bloomberg that policymakers are growing increasingly wary as the yen faces levels near multi-decade lows.
Their current policy rate, I believe, is 1%. So they're talking about raising it incrementally from there, and it's expected every 6 months. Now people are saying, well, could they make a move sooner than that? The fact that the market isn't responding more gives you a sense of just how much credence people are putting in this idea that right now the Prime Minister of Japan, Takaichi, has not really talked about the idea of a tightening policy. She's talked about a loose policy, has been much more kind of liberal with respect to spending. So to have some sort of policy shift on the banking side of things, the monetary policy side of things, highlights a quagmire that a lot of central banks are going to find themselves, where they're moving in an opposite direction from an administration.
The Federal Reserve at the moment is going through its own communication exercise. It'll say things enabling them to maybe anchor inflation expectations, but there's only so long you can do that for. And I think Japan's a fantastic example of that. Threatening to act, threatening to act, threatening to act. Now it's just a show me market. Coming out from the finance ministry and dropping the odd headline here and there. And I would say even the story, our reporting from BOJ sources suggesting they're willing to go further. It's pretty obvious why that story's come out this morning and why those sources were incentivized to get that out there in the news flow. Look what it's done to dollar yen. Dollar yen this morning has had a move of 0.1%, with the central bank threatening to hike more than markets expect. This is a show me market. Stories here and there, not moving the dial.
Yeah, we're still close to the weakest levels going back 40 years for the Japanese yen versus the dollar. And this is even with intervention from the finance ministry. So that gives you a sense that the finance ministry can't necessarily keep burning cash. It has to come from somewhere else, and it's got to be more than just words.
The move in crude is not helping. Brent crude spiking to a 6-week high this morning as the US and Iran downplay the prospects of negotiations. Susan Bell of Rystad Energy writing, I expect oil prices to continue to escalate. If flows out of the Strait of Hormuz cannot be re-established, demand destruction and high prices can be quite damaging to the global economy. Susan joins us now for more. Susan, welcome. We're often said when we hear from people like you, Susan, energy experts, not to focus on crude, but to look at crude product. Can we talk about refining capacity? How much spare capacity is in this system to address a much needed issue right now where we're getting a real squeeze in product?
The challenge is that the spare capacity exists in the regions that can't get access to crude oil. And so there really is very little spare capacity. I mean, when you look at what's happening in the U.S. is running their refineries harder than ever to try to backfill the lost supply into the Atlantic Basin that would typically come from the likes of Russia, the Middle East, and Europe is also running very, very high. Where there would be spare capacity is, of course, in the Middle East, but they have an egress issue. They can't get products out of the Strait of Hormuz. And then there's also spare capacity in China, of course. But China has chosen a strategy of minimizing crude runs to only supply domestic demand, helping the markets out, certainly, by reducing the amount of crude oil that they're importing by close to 5 million barrels a day. But not helping the markets out from a product supply perspective.
Do you think at some point China's going to have to reverse that policy when it comes to their imports?
I mean, if they have been drawing down their crude oil stockpiles in the order of about 1 million barrels a day since this crisis began. I'm pretty sure that they're loath to do that because those stockpiles are what is giving them a sense of energy security. So for them to reduce their strategy here and decide to increase crude throughput in their domestic refineries would be, they would have to also at the same time open up export licenses for those products to supply their neighbors and supply into North America primarily, into the western coast of North America. And then they would have to certainly start buying more crude oil, which compounds the problem.
We already know that when it comes to the Strait of Hormuz, vessels are not really going through anymore, and it's been really a halt in movement. But when it comes to the Red Sea, given the threat that we have now from the Houthis, have you seen a little bit less vessels go through?
We have seen a slowdown in loadings, yes. I'm not sure that it's necessarily turning into a slowdown of transits out of the south end of the Red Sea, but certainly that's to come. The Houthi threat has, yesterday it was reported that the Houthi threat has encouraged several vessels to turn around and not even enter the Red Sea for loading of crude oil. And the Houthis are specifically targeting vessels that are stopping at Saudi Arabia's ports. And Saudi Arabia is the one region that is able, the one country that is able to get crude oil supply out of the south end of the Red Sea and back to Asia. That they've been very critical in ensuring the flow continues to Asia to the tune of about 4 million barrels a day.
What's your sort of break point when we hit tank bottoms from your perspective, both for crude and crude products?
Well, I think, first of all, the issue is much more critical with regards to refined products. We started this crisis with about 4.4 billion barrels of crude oil stockpiles between commercial and strategic reserves. But we only started this crisis with about 1.4 billion barrels of key products, gasoline, diesel, and jet fuel. Products have drawn in the order of 200 million barrels. Crude oil has drawn in the order of 200 million barrels, but products just had a lot less to start with. So the crisis is intensifying on product stocks, and you're seeing that certainly in crack spreads. At the start of this crisis, gasoline crack spreads were very lackluster. In the US, they were maybe $8 a barrel net of the renewable volume obligation cost. Europe, the crack spreads were a bit stronger, but we're now seeing gasoline crack spreads in the order of $40 to $50 a barrel, and distillate crack spreads have also surged with the surge in the conflict. With crude oil, there still is room to draw down SPRs and commercial stockpiles. But the tank bottoms are a lot greater in crude oil just because the infrastructure to move the volumes around the globe is much more significant than product infrastructure. So we don't have, it's not like we've got 4 billion barrels of crude oil sitting there for us to use. Upwards of 50% of that volume could be truly tank bottoms that are inaccessible.
Some politicians wish we did, that's for sure. Susan, thank you. Susan Bowder of Rystad Energy, thank you very much. There is a heightened sensitivity to the headlines on the tape this morning, and you can just see that in the last few minutes or so. Sirens sounding in, say, Bahrain, alerts in Saudi Arabia. As those headlines cross, crude just ticking a little bit higher again. Brent back through 95. As you get that move through 95 on Brent, equities pulling back. Not major moves, just a tenth here and there. You see that on futures this morning, with crude up by more than 4%. Futures just pushing a little bit lower on equities too.
Absolutely. And when you're talking about alarms going on, one of them was issued in Saudi Arabia in Dammam to warn of danger. Well, that's where a lot of their refining is. That's where the Aramco headquarters is. This is the concern right now in the region because the escalation of the actual kinetic attacks is continuing 11 straight days. At the same time, no vessels are moving through. So even if you're concerned about where the rhetoric is going, Just look at the actions and what's actually going on the ground, and you can see the heightened volatility.
Equities down by 0.4 on the S&P with an update on stories worldwide this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. OpenAI is saying its advanced AI model accidentally hacked Hugging Face. The ChatGPT maker is saying the model broke into the AI model and database host during a cyber capability evaluation. The accidental hack prompting calls for more oversight and regulations on the technology. GE Vernova shares are falling in the pre-market, the energy giant raising its full-year forecast following strong quarterly revenue that beat expectations. Investors, though, uneasy over its miss on core profit estimates, alongside warnings of continued revenue declines in its wind division. New Jersey Governor Mikey Sherrill says about 6,600 people who identified themselves as non-citizens were registered to vote in 2023 and 2024. Sherrill saying it was due to a software error in the state's motor vehicle system. That is your Bloomberg brief. John.
Bonnie, thank you. Thanks for the update. Up next on the programme, inflation anxiety on the rise.
Inflation has been above target for quite some time.
It's all fun and games until the Fed has to pump the brakes.
He needs to do something, and we think 3 rate hikes is the way to start.
Up next, Simona Mocuta of State Street, live from New York City. You're watching Bloomberg TV. Oil in the driving seat. Brent crude topping 95 moments ago. Once again, this morning, 94.40. We started July with a 71 handle, with hopes that we could break into the 60s. We're ending July with a 94 handle, with fears that we could break back into triple digits. The strikes continue, 11 consecutive days. What's becoming more and more important, what is being hit, what might be hit, and what isn't being hit.
So Iran, apparently, according to Tasnim, is saying that Lark Island was targeted by U.S. missile attack. We are getting more details today about what actually is being hit. You see the United States actually extending and expanding what they are striking. It hasn't just been what's going on in terms of drone facilities and a lot of installations Iran has to target vessels, but also goes to going after some things that are dual use, like civilian infrastructure, like bridges. And the hostilities continue once again, and Iran, as you see, is retaliating.
Setting the tone for financial markets cross-asset. Equity sliding, Bramo yields higher, up another basis point, 10's now 464, near the highs of the year.
Over to you, ECB. And ultimately, the issue with the ECB is that they're facing both a similar type of move in yields and an even bigger move in some of their distillates and their natural gas, which have risen to near the highest levels going back to 2022. So that connection between yields and some of the commodity sector really has to be tied starting this week and then next with the Federal Reserve.
22 is not a good year.
That's not a good year.
For the Europeans or for many others for that matter.
And that was later in the year in terms of the comp, but still we're talking about the same kind of Ukrainian war disruption levels that we saw back then.
Let's talk about the backdrop for inflation and for these central banks. Under surveillance this morning, inflation anxiety on the rise.
Inflation has been above target for quite some time.
The inflation situation is extremely complicated.
It's all fun and games until the Fed has to pump the brakes.
Kevin Walsh has said this. Interest rates may just be too low for the level of inflation that we have.
He needs to do something, and we think 3 rate hikes is the way to start.
So here's the latest this morning. Headlines from the Middle East sending crude prices higher once again. Brent briefly touching 95 a barrel, reminding Wall Street the fight against inflation is far from over. Simona Mocuta of State Street writing, our house view is that the Fed remains on hold through year end, but Fed speak clearly points to a rate hike as the risk scenario. Simona joins us now for more. Simona, welcome to the programme. What is going to keep this Fed on hold?
Well, I think it's a combination of things. You know, to be fair, the case for a rate hike and for some tightening from the Fed is very easy to make precisely on the basis of what was discussed on the program already. You're not where you need to be on inflation. We understand that. We acknowledge that, right? But you have to ask yourself, are rate hikes going to be effective in fighting the type of inflation and the sources of inflation that we are dealing with today? And I think our view is the answer is no. And if you do hike, are you resolving the problem that you're trying to resolve, or are you potentially accentuating issues that you want to not come to the surface. We happen to see the labor market perhaps in a little more vulnerable state than the prevailing narrative makes it sound. I don't think it's all a bed of roses in the labor market, and I am concerned that if you have policy tightening, you might, that would be detrimental to the labor market. And then everything from there has a bit of a snowballing effect. You look at consumer delinquencies, those are very high across a number of dimensions, and they are very high in an economy that supposedly is at full employment. What happens when we are no longer at full employment? So it's, we want to do something. You have the urgency and the sense that you should be doing something, but what should we be doing? And perhaps the best thing to do is not do anything.
Can this Federal Reserve afford to do that if you have the market suggesting that they are moving and not suggesting it, but telling them that they are moving and pricing it in already?
Yeah, I think it's still a bit of a, circle there. There is, obviously Chair Warsh is telling the market, you look at the data, you make your own decision, don't wait for us to signal. But I think there is still a bit of a back and forth going on there. And again, the risk scenario truly is for a hike. We talked about oil prices today where we end July. A week and 2 weeks is a very long time in this world. And the difficulty for the Fed is that they are dealing with the oscillating shock. You could almost describe it, right? Things are deteriorating, things are improving. Like, at what point do you choose to act? And that's very, very difficult because you may act, and by the time your hike actually feeds through the system, the underlying situation may have resolved. And the other point to make is how many hikes, right? The market's pricing, about one, a little bit more than one. Do 25 basis points really alter the trajectory here for inflation in the bigger, understanding of that, or specifically as it is feeding through from energy? Again, it does not seem particularly effective, and as you think over the horizon, a year from now or 6 months from now, what are the underlying dynamics in the economy? It's very complicated. So I don't think the case for a hike is clear-cut. I think, Chair Warsh mentioned that the stance of policy is nuanced, and it's very true. This is a K-shaped economy to the max. It's not just in the consumer space, it's in the investment space. I mean, look at housing, look at residential investment versus AI. Again, would 25, 50 basis points worth of hikes stop the AI enthusiasm? Probably not.
Simona, it's good to catch up with you. I appreciate the reaction. Simona Mocuta there of State Street Investment Management on the outlook for the Federal Reserve. Got Jim Zelter on my shoulder from Apollo just saying,
take a walk.
Take a walk. Touch grass, right? Calm down. 6 months from now, we won't be talking about this.
And I think a lot of people are saying the same thing. What's one rate hike going to do
anyway? Brings me a lot
anyway?
of comfort, that does. Thank you, Jim. Equity futures this morning, down by about 1/3% on the S&P. Up next, we'll catch up with the AT&T CEO, John Stankey, following fantastic results from them. James Picariello of BNP looking ahead to earnings from Tesla, plus Wendy Stewart of Bank of America, Mona Mahajan of Edward Jones.
What we have seen is a much higher baseline level of volatility for technology stocks.
Some of these moves have been absolutely parabolic.
It's becoming a little bit more consensus, at least, to lean a little bit more into the hyperscalers.
You got the hyperscalers. They're spending like drunken sailors.
Can the build of AI get done as fast as the market expects?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity slide following yesterday's bounce, snapping a 3-day losing streak. We're losing again on the Nasdaq. We're down by 0.8%, taking back some of the gain in the last 24 hours. In the bond market, yields elevated, up a single basis point at the long end of the curve. 10s back to 464, 2s closing in on 430. Off the back of this, crude for sentiment this morning in the driver's seat, at least for now. Brent crossing 95 not once but twice earlier on this morning, up by close to 4%. WTI close to 88.
And it's breaking through some thresholds when you look at the actual crude-related products. And that's what a lot of people keep mentioning, the fact that, yes, crude prices have risen significantly, but not as much as things like natural gas over in Europe or potentially even heating oil here in the United States. And you start looking at levels that we haven't seen since 2022, you start to say this is going to pressure people and people cannot ignore. And that is the reason why you are seeing a bit more of a reaction, even if the Fed might look through it.
I'm glad you mentioned Europe because they have serious problems right now. The Equinor CFO was talking about the fact that it's incredibly difficult right now for Europe to make sure they're getting those storage levels they normally have in the summer for the winter months. It's really been a double whammy when it comes to Russia's invasion of Ukraine. They had to outsource their LNG supply to Qatar, and now Qatar cannot get vessels out when it comes to LNG because what's going on in the Strait of Hormuz. And then you just continuously see the hostility and the volatility in the Gulf continue. Now we have Iran reporting that Iran's Lark Island was targeted by U.S. missile attacks. Yesterday, another night, 11th straight days of hits that the U.S. is targeting the Iranian regime.
These moves have got a firm grip, a hold over market sentiment so far this morning. I say so far, I say for now, because later on we'll get some earnings. Alphabet and Tesla in the mix after the closing bell. That's going to dominate the focus of this market, particularly stateside. Later on, following fantastic numbers from AT&T. And we've seen this from company after company across sectors in this country, corporate America executing against a really good backdrop.
Yeah, even though there is incredible competitive pressure, the idea that AT&T could come out and add more than 100,000 subscribers than people previously had expected gives you a sense of where the outperformance has come into play. Also, the bar was a little bit lower because the shares had not performed as well year to date, down about 10%. So how much is that really leading to the boom that you're seeing this morning?
Coming up, we'll catch up with the man himself, the AT&T CEO, John Stankey, on the company's strong second quarter. Bank of America, President of Commercial Banking, Wendy Stewart, on the state of the nation's mid-sized companies, and Mona Mahajan of Edward Jones on how tech could reclaim market leadership. We begin this hour with stocks inching lower as earnings season enters full swing. AT&T shares gaining after crushing estimates on mobile subscriber gains. Joining us now to discuss, the man himself, the boss, the AT&T CEO, John Stankey. John, welcome to the programme, sir. I want to talk about execution. There's so many issues to talk about with your company, but just execution. These numbers this morning, John, the street's looking for like 325,000, and you deliver 432,000 monthly wireless phone subscribers in 2Q. What went right, John? What was the strategy behind a gain that big?
Well, I think going into the break, Jonathan, you referred to the results as fantastic, and I would agree with you. And I think the team did an excellent job executing, as you said. And it's not just in our wireless business. It was nearly 370,000 fiber net adds. That's a record for us in this quarter. Look, what went right is what we told people was going to happen this year as we gave guidance for the next 3 years. We said because of the investments we've been making in this business over the last 5 years at a sustained and targeted level, and the M&A work that we had done, acquiring more spectrum and picking up some additional footprint from Lumen, that you should see a step up in growth as a result of those things. The team had the asset base it needed to execute and drive growth at a faster level. And you saw the manifestation of that starting to happen here in this quarter. And it's showing up in accelerated service revenue growth. It's showing up in accelerated EBITDA growth. I would even go into our business segment and point out that we had growth in our strategic services for business for the first time in a very, very long time. And as a result of that, we expect that that's going to sustain itself through 28. So we're executing well. We're hitting on all the cylinders in the engine. And when that happens, the business can deliver the kind of results you're seeing. And I'm pretty confident we can keep that moving going forward.
John, there's a number that jumped off the page for me this morning as well. It's 42.5. 42.5% of households that purchase the broadband service from you also buy mobile phone service too. How important has that convergent model been just behind the success you're having, and how important will it be for the remainder of the year?
It's extremely important. It's actually, that number's 45% if you were to normalize it for the Lumen footprint that we just recently brought in, that's diluting the number a little bit. And as you know, you see in our report, that's been ticking up steadily. And it's important because, one, those customers are more lucrative customers when they buy multiple products and services from us. Two, churn goes down, and that's one reason why you're starting to see our churn numbers improve this quarter, because we're starting to get that benefit of that base that is buying both together from us. And three, brand affinity, the customer's happiness with AT&T and their impression of the brand. is much higher as a result of that because the products are better together. So it's really important we continue down that path. And it's frankly one of the most important things as you think about our competitive positioning moving forward, because we can provide world-class networks in both wireless and fixed that tackle 98% of what a customer needs to do on the internet. Occasionally they walk off one of our networks, and as you look at our partnerships that we're working with the satellite industry, by this time next year we'll be able to solve that problem. And so we're the natural place for people to come and meet their needs on the internet and do it easily on one bill with one set of services and one support infrastructure. We think we're in a great position as a result of that.
And John, this is a reason why there has been really a price war between different providers, simply because everybody wants that package, right? They want to get everybody. How has the competitive landscape changed, though, over the past couple of years with the introduction of satellite services, of what we're seeing with Starlink, of what we're seeing elsewhere?
You know, I don't characterize it as a price war. I think there's been a stratification of pricing for customers depending on what kind of services they want to buy. There's the segment of the market that needs high-performing, symmetrical gigabit services, very robust wireless plans. That segment of the market is willing to pay for that, and they pay a premium as a result of that exceptional value that they get back. We've played very, very well in that space, given our asset base. But there's also a segment of the market that's more value-oriented. And I would say choices have come into the market because of good regulatory posture that have allowed investment that weren't there before. And those choices are putting more value-oriented products and services at more attractive price points, but the product and service maybe isn't as robust. And at AT&T, we've played really well up market, but not as well down in the value space. And we've been working hard to get our product portfolio so that it matches up across the entire continuum of the market. You saw that in the results this quarter because our account additions, new accounts to AT&T, hit like a 3-year high. And that's because we're doing a lot better job down market. And there's nothing wrong with having a more affordable product that's tuned to certain parts of the market. I don't consider that a price war. I consider that meeting market needs, as long as you're doing the things that you can do up market, which we've done very well. And I think when you see margins the way they are at AT&T, this is like a record for us. That's a good sign that we're getting that balance correct.
Over the next 5 to 10 years, John, how do you see the breakdown of the mix of broadband and fiber on one hand, the wireless or the more budget-sensitive areas, and then satellite from the likes that you're seeing from Starlink?
Look, my point of view is they have a fantastic product. There's great innovation that's moving in that space, and it fits a part of the market that hasn't been well served, especially in less densely populated areas. And the interesting part about that is our investment has largely been in urban and densely populated suburban. We haven't pushed real hard in the rural and less densely populated areas. That tends to be more the stronghold of cable companies. I think they'll do pretty well in that space, bringing an alternative and competition in there. I think it's going to be very hard to come into the more densely urban populated areas to compete with that bundle that I just talked about earlier of fiber that is the best product in the market, best performing. It's the lowest marginal cost, our great wireless density that far outstrips what you can do from direct-to-device and satellite. Years of investment in the hard-to-reach places like stadiums. Everybody who went to a World Cup game knows how important being able to connect in a stadium is to experience what goes on socially and actually in the arena so that you can see a few replays that they're not showing there. We've been doing that for a long, long time, and it's going to be very, very hard to catch up on that infrastructure. And I think we're going to do really, really well competing in metro and suburban areas, which is where our investments have been.
And John, you've talked a lot about how fiber puts you in a really good position in the AI era and how an increasing number of businesses really do need that kind of connectivity and the latency that's so important to improve. And I'm just wondering, aside from the demand side, from your actual corporate side, if you've been able to calculate any of the return on investment of your own uses of artificial intelligence. I know you've been really vocal about how it has improved efficiency dramatically. Has there been any ROI? Have there been any structural changes that you're able to disclose?
Yeah, we've been really disciplined about this, and I'm satisfied that where we've been investing in places like in our software development organization, what we've been doing in our customer service channels, our applications into engineering, some of the things that we've been doing and building the right algorithms for pricing support, that we've gotten very strong returns. And as a result of that, I would almost argue people inside of our company maybe think we've been a little too judicious about how we've managed investment. We're trying to find that right balance of innovation and allowing things to run and the discipline of ensuring that what we're doing drives return. I would also say that I'm very well aware that a lot of this investment is a competitive necessity. When we improve operations like customer service and call centers, I don't know that that's necessarily sustainable. I think those are ultimately efficiencies that get competed away in the market. They go to the customer in the form of lower prices or better service. There are the things that we do that really give us strategic advantage, like maybe writing software for capabilities that we didn't have before that make us better at pricing or better at driving yields on the network or more efficient. Those are the ones that maybe we get to keep some of the benefit on. And if I were to say that we need to do something better moving forward, we need more of the ones that drive strategic advantage to balance out some of the ones that we know are just the table stakes that we need to compete in the market and drive the great margin performance that you're seeing right now in the quarterly results we just published.
John, I'd love to finish by talking about the stock as well. Just listening to you speak about the degree of investment you've put into the business to serve these areas, densely populated urban areas across this country. And when I think about other companies right now spending a fortune, raising loads of capital and going through this massive capex cycle, I'm thinking of tech and what's happening there. You're in a different position. You've done some work already. Then I see this headline. You're accelerating the pace of planned share repurchases. Can you walk us through just the characteristic of what's on offer now, your stock, and how well understood you think it is with investors at the moment?
Well, look, I think the markets eventually get things right. It doesn't mean that they get it right every month or that there isn't momentary dislocations and readjustments. And my point of view, obviously, I'm probably speaking my book, I think we're in a little bit of a dislocation right now. And there's certainly a desire to raise capital to move to new opportunities in the AI space. And, I think there's been some rotation out of our stock as a result of that. But here's what I know. We've built this business for the future. To your point, we're building symmetrical networks that have as much upstream bandwidth as they have downstream bandwidth. And we think that's going to be critical in the AI world, just like memory is critical, just like chips are critical, just like data center infrastructure is critical. And I do believe that the market will eventually understand that what we have built is indispensable for the kind of workloads we're going to see in this AI environment working forward, and that AT&T is uniquely positioned in the investments we've made over the last 5 years to serve more of those workloads more effectively than anybody else. And eventually the market will figure that out. And when the cash shows up, valuation will ultimately correct itself. And I have the confidence that that's the case. Our job as a management team is to continue to execute and stay focused on the plan that we've laid out. And I believe this quarter is a testament that this management team is in fact doing that.
Message received in the stock market this morning, the stock kind of the pre-market by 4%. John, we appreciate your time, sir. Thank you. John Stankey there, the AT&T CEO. Great report, decent numbers, accelerating the share repurchases as well. Music to the ears of investors this morning.
Yeah, and frankly, AT&T is putting their money where their mouth is with respect to increasing their share buybacks that they plan for the rest of this year. Also seeing, exactly as John was saying, something of a dislocation. Interesting to see the dissonance between that and the likes of GE Vernova that came out and outperformed with their earnings, but are being punished in the market. Just sort of an interesting sort of a contrast between expectations and what gets delivered.
That stock is up this morning in the pre-market. Equity futures down about 1/3 on the S&P, with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump minimizing the prospect of immediate talks with Iran as the two sides exchange strikes for an 11th straight day.
I will tell you, they want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest in even.
Iran confirming mediators reached out with proposals to ease hostilities. OpenAI appointing 2 financial services executives to its board of directors. The CEOs of BNY and Nubank joining the company's for-profit and non-profit boards. The ChatGPT maker is said to be considering an initial public offering as soon as 2027. New York City Mayor Mamdani withdrawing his pledge to arrest Israeli Prime Minister Benjamin Netanyahu during the Prime Minister's visit to the city in September. Mamdani citing a lack of legal authority. The mayor calling on the federal government to join the International Criminal Court and execute the arrest warrants. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate the update. Up next, the Morning Calls Plus, James Picariello of BNP Paribas looking ahead to earnings from Tesla.
I do think we can get pretty broad-based earnings surprises again. I wouldn't be surprised if we get similar magnitude of earnings surprises in the broad-based sense, comparable to what we had in Q1, and then it really depends what the market is doing. If we don't see that coming, then I'm afraid to say, it's like, well, what's going to propel us even higher here? I think then into September, October, you want to take a bit of risk off the table.
Max Kettner of HSBC on the edge of bearish, almost there, just on the edge of bearish. Equity futures this morning negative by 0.4 on the S&P 500. That right there is your price action. Here are your morning calls. First up, Barclays raising its price target on Supermicro, citing improving margin forecasts. Your second call from Goldman, raising its price target on GM, seeing healthy dealer inventory and a new pickup truck cycle ahead. And your third and final call from Wells Fargo, raising its price target on SanDisk, citing a tactically positive setup leading into fourth quarter earnings. Elsewhere, big tech earnings in full swing. Alphabet, Tesla, IBM results all due after the closing bell, with companies facing a very high bar on Wall Street. Ed Ludlow has more. Good morning, Ed.
Good morning, John. Spending is the overriding theme, right? But each of those three companies' relationship to the spending story is very different. In the short term, Alphabet going beyond capex expectations of $190 billion at the high end would move the needle. But it's really about returns. 20% top line growth, where 65% cloud growth is the minimum. You're completely right that particularly on the buy side, expectations are really high. They want to see something in return for the patience of letting Alphabet and other hyperscalers spend to that level. Tesla is a very different story. The street is calling out for Tesla to put its money where its mouth is. $25 billion of capital expenditures this year is unprecedented for Tesla, but they want to see on a quarterly basis them spending at or above that level to get going on those future businesses, robotaxi, humanoid robots. The stock right now is priced in those businesses. The street wants them to act on it and make them real. And then IBM, the question is AI spending leaving everything else that's not AI to one side? You know, they had to prelim release their earnings where there was a lot of evidence that that was the case.
You've got a big day coming up. I'm looking forward to the show. Bloomberg Tech.
Thank you.
A little bit later, a few hours away with Bloomberg's Ed Ludlow. Looking ahead to those results that Ed was talking about from Tesla, James Picariello of BNP Paribas with an underperform rating, 280 price target on the stock. He writes the following: we fear the company will face daunting key performance indicators at its robotaxi and Optimus business over the next 2 years, bringing downside risk to core operations before any SpaceX merger could realistically materialize. James joins us now for more. James, good morning.
Morning.
I mean, the last line is the most important line for many people, is how soon before it's realistic that these two companies get together?
Yeah, that's what everyone wants to talk about. I think a merger is going to take time, right? I mean, there's been some rhetoric that a merger can get fast-tracked during, within the current Trump administration. And
what do you think needs to happen?
Well, you certainly need China and Europe regulatory approval. You have defense contracts involved when we think about SpaceX. It's going to be a slog, I think, right? So there's going to be time for Tesla on its own to have to deliver on certain KPIs, right, around robotaxis and Optimus. And yeah, I think the bar has been set quite high in the valuation, and there's downside risk.
Well, let's talk about the robotaxi rollout. Where are we?
So they were in 4 cities as of the first quarter. They had targeted to expand to another 5 cities by the first half. They missed that target, but just this week they announced that they're in Tampa and Orlando. So they're expanding their robotaxi fleet in terms of the city coverage. But if you look at the availability of that robotaxi fleet, there's no great explanation on this. It's come down quite significantly. So the fleet size is in place, but the availability of that fleet has come down over the last 3 months. And it speaks to the difficulty in managing a robotaxi operation.
Tesla used to be kind of a public wrapper for Elon Musk. It was essentially you're buying Elon Musk with the wrapper of Tesla. It wasn't a car company. It wasn't exactly something else that you could put your finger on. What is it now when there's another wrapper for Elon Musk that's out there? Yeah,
I mean, certainly with SpaceX, Elon is going to have to share his time between SpaceX and Tesla, right? It's not just Tesla. So that complicates things a bit. I mean, for Tesla, it's about robotaxis and Optimus, and there's a high bar. People, there are bullish expectations for Optimus to achieve 1,000 units per week once they hit commercialized production by October. I mean, we're getting close.
What's the obstacle? Is it the supply of actual equipment, of actual cars that are outfitted with the right technology, or is it a permitting issue and a question of the regulatory oversight that would enable a broader adoption?
Well, it's the permitting for sure, but to get to this full future picture of what's envisioned for Tesla, there's a lot of CapEx investment, right? Tesla needs to make this conversion as a true AI company, right? That's been the thesis for many years now. We're talking about at $25 billion in CapEx guided this year, right? That leads to close to $10 billion in cash burn for this year. Over the next 3 years, I have almost $20 billion of cash burn, and that's with strength in the auto and energy storage businesses to help mitigate that cash burn. That's the real dynamic that the expansion of these AI-led businesses requires substantial CapEx investment, and that interplay, the timing needs to be pretty precise.
Which is why you're at 280 and the stock's at 375 this morning. It's funny, years ago, if we had a Tesla conversation, we'd be talking about one thing, and that's the car. Auto sales, deliveries, those kind of things. You can have a 5-minute conversation, 10-minute conversation on Tesla now and not even talk about deliveries.
And arguably you shouldn't have back 5 years ago either, because it wasn't about that either. The cheaper it gets, the cheaper it'll be for SpaceX to eventually take it over. So there is that potentially could be a saving grace.
James, good to see you, buddy. Thank you. James Piccirillo there of BNP Paribas. Up next, we'll catch up with Wendy Stewart of Bank of America on how mid-sized companies are navigating headwinds in this economy. The opening bell is about 60 minutes away. Yesterday was a better tape, a better story. Chip stocks picked up on Monday, picked up big time on Tuesday, 5% rally. This morning we take some of it back on the Nasdaq. The Nasdaq is lower by about 1 full percentage point. On the S&P, we're lower by 0.4. The Russell also down by 0.4%. Small caps, of course, have had a wonderful year, fantastic year to date up until now. In the bond market, 2s, 10s and 30s, just that repricing of rates coming through this market again this morning. By basis point, just grinding higher. Before you know it, you're at 430, 427. This time a week ago felt so different. You just had softer CPI. A week ago, you just had softer PPI, and you were talking about removing the urgency to hike interest rates. Beth Hammack into the weekend? I don't think so. I think we might have to hike interest rates, was essentially the message coming from the Cleveland Fed president. Then you get this move in crude, adding to it again, and you just wonder what is the hawkish risk into the Fed's meeting a week away, with crude early this morning briefly breaking 95 this morning, back to about 93.90.
It used to be that the Fed was a central bank to the world. Right now, I would argue that there is an eye toward the rest of the world as well, because it's not just the Fed that has to grapple with where oil prices are. It's also the ECB, which comes out tomorrow. It's also the Bank of Japan with questions over whether it might be incentivized to hike rates more quickly. And that starts to raise a question, even if people say it's transitory here in the United States. If you get a CPI and PPI that reignite in terms of the heat under there as a result of what we're seeing in the move from oil, does that lead to a different calculus at the Fed than some people might have expected in the past, that it would just be looked through?
Isabel Schnabel, Executive Board Member, ECB. first week of July, July 6th, if I remember correctly, she comes out and she says, this is no longer a shock you can just look through. Since the start of this month, you've had a 30 basis point move on twos in Germany. Compare that to twos in America. I think we're higher by mid to high single digits. Let's call it 8 basis points higher on twos so far month to date. It's in a much bigger move in Europe. And you often say single mandate central bank, one issue. And it's harder and harder to look through that one issue.
If you see that natural gas prices are near the highest in Europe going back near to 2022, you start to think if they're looking at that one input, it is not going in the right direction, and they have to preserve the validity of the euro at the same time that you're looking at other drivers of dollar dominance. This is the reason why you start to think maybe it could be a live meeting.
This time tomorrow. An ECB meeting coming right up, a news conference too. As we count you down to that and to the opening bell some 60 minutes away. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start with the latest trouble in the software sector. We are seeing shares of Pegasystems down nearly 18% in the pre-market after the company came out with results, and they came in lower than expected because it is saying that its customers are delaying orders as they pour more resources into the AI build-out. It echoes what we heard from IBM last week, warning us about its results, which are out after the bell today. Turning to Reddit, those shares also falling in the pre-market, down nearly 6% as the Wall Street Journal reports that the company is reconsidering its AI partnership with Google. Under the deal, Google pays Reddit some $60 million a year for access to its posts and conversations in order to train its AI models. But Reddit is reportedly questioning that now because the search tools are increasingly keeping users on Google instead of them going onto Reddit. And Supermicro, that name is surging in the pre-market, up nearly 13% now after it came out with preliminary results reporting a record backlog of about $60 billion and better than expected margins. This is also being taken as a sign that that customers are looking past some of its recent controversies because it is being investigated by authorities here in the U.S. and Taiwan over allegedly sending AI servers to China with restricted NVIDIA chips. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Speaking of chips, this just dropped from the Journal just moments ago. AMD and Anthropic, I'm going to read the story verbatim for you, have just signed a deal for tens of billions of dollars worth of artificial intelligence servers, strengthening AMD's competitive position against the industry leader NVIDIA and supplying Anthropic with much-needed computing power. The Journal story goes on to read, under the terms of the agreement, Anthropic will purchase up to 2 gigawatts of AMD's latest generation chips. AMD will also invest up to $5 billion in Anthropic, its first check into the firm, as certain deployment milestones are met. AMD this morning down about 3%.
Yeah, Anthropic is working already with a lot of Google's TPUs as well as Amazon's Trainium chips. You've seen them also, of course, deeply intertwined with NVIDIA. So they're trying to gain partnerships with all these different chip makers. And you can see the incentive for AMD to say, we want to be part of your ecosystem. Again, though, this is going to go to the questions of circular financing, of how much some of the chip producers are investing money in the likes of Anthropic or OpenAI to then have that money be spent on their particular chips, et cetera. This is what people were worried about earlier this year. And again, I'm sure it'll come to the fore now.
We'll keep asking those questions. AMD this morning at the pre-market down some 3%. 1 week away from a massive, massive week of earnings and a Federal Reserve decision sandwiched in between. The July interest rate decision just a week away, a week on Wednesday. Into that, crude climbing to 6-week highs as inflationary pressures continue to build across the economy. Mike McKee has the latest. Good morning, Mike.
Good morning, John. Well, you're talking about the Fed a week away, and it reminds me of a line that Donald Trump uses often. Many people are saying, you're starting to hear people say, maybe a rate increase is going to be on the table. They might not do it because they're only a few days away this time, but we've already almost priced in a September move, and we have priced in an October move. More on that in just a second, because it looks like inflation is coming back. Now, we have seen crude oil rise. That's pushing up gasoline prices. As of yesterday, $4.06 a gallon, well over that $4 mark. Gas Buddy's forecast as we go in the next week to $4.15. The June average, though, was $4.07. July so far, only $3.89. So when we get to the CPI, you may not see an impact in July because they look at the average changes in a sort of rough sense between month over month. And you go back to May, the high was $4.58. So we may not see it in the CPI yet, but it is coming if this all continues. And one of the worries out there that you hear people in the oil markets talking about is inventories. 10:30 this morning, we get the latest inventory numbers. Now, these are last week numbers. This is the days of supply out there right now at about 23. When you get to 20, that's called the flashing yellow light that we're starting to get short of oil. If it dips below 20 days supply, we're going to have some shortages somewhere, and then that'll send prices much higher. So that's something to keep an eye on when we get those inventory reports. And then the Fed out there has some other things to worry about, the Houthis and the Red Sea. Does that send oil prices higher rapidly? By the end of the week, more tariffs coming. Well, they're already coming because the president put some on Canada. And then AI inflation is the new worry that we saw in the minutes. They're getting concerned about that in the short run. You see the Anthropic news with AMD today could push prices higher. So a lot for the Fed to think about. Now, the big question is, when would you raise rates if you think you need to raise rates? October is 4 days before the midterm elections. They're not going to want to do it then because then they'd be accused of influencing the elections. September looks good at this point. But if you really want to get out and ahead of the game, why not do it next week? Two-year note has already priced in a Fed move. So something to keep in mind as we get closer and closer to that Fed meeting.
Mike McKee, appreciate the update. Mike, buddy, thank you. Looking ahead to that meeting next week, let's talk about the backdrop on this economy right now. Bank of America with a front row seat to mid-sized businesses in the United States. Wendy Stewart, the president of Global Commercial Banking, has an optimistic outlook, writing the following. Our first half results demonstrate that middle market companies continue to invest for growth, even in a complex operating environment. Wendy joins us now for more. Wendy, welcome to the program. The business at Bank of America, as you know well, serves 1 out of every 5 middle market companies in this country, in this economy. So, Wendy, you've got a fantastic read into the broader economy at the moment. What is confidence like in the C-suite at the moment? We've been talking about risk all morning across several dimensions. What's confidence like at the moment?
Well, good morning, and thank you for having me. It's nice to see you. So you're right. We do work with a lot of middle market companies. We cover U.S. and Canadian-based companies and their international subsidiaries around the world. So we do have a pretty good view as to what's happening. And I would say confidence is cautious, but also investing in growth. Our clients are very resilient, and they are looking to grow this year. And we've seen that in a variety of ways. They are investing in their companies. They're digitizing, and they're leveraging strategic advice to navigate the geopolitical and the economic environment that has been quite uncertain for them this year.
Do you think it's defensive, Wendy, or is it opportunistic? When you think about things like mergers and acquisitions, the potential to expand, is the opportunity right now because they see great gains in the future? Are they on the back foot? How do you read things?
So it's both defensive and it's offensive. And so, we just announced earnings last week, and we had a strong second quarter, and part of the driver was investment banking and M&A. And in our space, covering the middle market companies, we were up 50% year over year, and M&A was a big driver for that. And, we work with a lot of privately held companies, and they are looking for growth, so you might call that more offensive. They're also managing risk, so you might think of that as defensive. And then they're also managing succession planning. And in fact, we worked with a company recently who did not have a succession plan. And so they decided to sell the company to an investment management firm because they wanted to make sure that the company was prepared for long-term growth. They also wanted to make sure that their employees had a future with the company. And then they were also looking at preserving the family's wealth. And we were able to work with them and accomplish all three. It's been a big area for us. We just announced that we are hiring 10 new regional investment bankers who are joining us later this year so that we can continue to help our clients with all of their strategic needs.
Do you think that we're at the beginning or the middle or near to the end of this M&A cycle in the middle markets?
I would say that we are somewhere in the middle. It feels like it's been strong for the last 18 months, and we still have a strong pipeline ahead. So I don't see that we're anywhere near the end. And, we do feel like we're well positioned to continue to help our clients. And, they are looking at growth in a variety of ways, not only in the United States, they are also growing outside the U.S. They want that opportunity to grow into other regions. They've got to manage supply chain. They've got to manage other risks. And doing business outside the United States is actually providing them an opportunity to do that.
How open does the market need to be for some of these players for them to continue with their expansion plans? In other words, is this pipeline potentially at risk if rates rise to a certain degree, or say if there is some sort of drawdown following the earnings season in big tech over the next week?
So, our clients are not as interest rate sensitive as you might think. And in fact, when we talk with them about that, they'll say a 25 basis point move here or 25 basis point move there really doesn't impact their long-term objectives and how they execute on those. Because again, a lot of these are privately held companies, so they don't necessarily think in quarters the way that publicly traded companies do. And so, we feel like they're well positioned and that the interest rate environment, even if rates move a little bit, isn't going to impact the strategic decisions they're making for the long term.
It's interesting you say that they continue to make these decisions for international growth and new markets at a time when this White House is involved in a conflict in the Middle East and there's continued threat of tariffs. How have these companies been able to weather all that?
Well, they are very well diversified, and they're continuing to look at the political environment and how these macroeconomic trends are impacting them. And, again, they're making decisions for the long term. So they might make a decision because they're looking out not just, a year or 2 years from now, but they're looking 10 years from now and trying to identify where those opportunities are for the long-term growth. And so they might make bets and grow in areas that are a little bit unexpected. But again, they have the ability to do that over the long term because they are thinking 5, 10, 15 years out.
Wendy, we've got to ask you, you're in Atlanta. How many World Cup games did you watch in the last 6 weeks?
Oh gosh, the World Cup dominated our company and my life over the last month. It was a fantastic experience. I went to many matches. I had the opportunity to host clients around the country, and it was a terrific experience, I think, for us as a company. We had 3 objectives we wanted to accomplish. The economic impact of the World Cup is very real. We're expecting a $20 billion impact, and we were really excited to be a part of that. It's great to be a part of the community impact and the legacy that a lot of the World Cup will leave. We've been partnering with cities around the United States to leave fields, soccer fields, so kids have access to soccer long after the World Cup. And then our clients had a terrific experience, and we were delighted to host clients at all 104 matches.
Amazing. Love that. Wendy, thank you. Appreciate it. Thank you very much. Wendy Stewart there of Bank of America. Was kind of jealous of the team over at Bank of America over the last 6 weeks.
I was just thinking, is she hiring? Because it sounds like a really nice.
Can we come next time?
Yeah, exactly.
Except some took advantage of it. It sounds like Wendy did it right. Brian Moynihan went to one
Brian
match.
went to
or
one
two,
game.
because went to the final.
Well, he went to the final too, yeah. Wendy was clearly very busy.
Yeah, good
over
for
the last
Wendy.
6 weeks. On a most serious point, the serious point that I took from that, there were many, but this one, how rate insensitive some of her clients are right now. They're 25 basis points here and there. It's not going to move the dial or change their plans.
And they have longer-term plans that they're trying to that are coming to fruition at this point. And the other calculus, which is AI adoption, they have to ultimately defend their market share and expand at a time where these are costs just to stay competitive. Just think about what John Stankey was saying. A lot of the AI efficiencies are just the cost of doing business. They're not going to come to their bottom line. They're going to have to translate into, frankly, lower prices for customers.
If her clients and the businesses she deals with are rate insensitive, who are the clients and companies that are calling the Cleveland Fed president?
I thought the same thing.
Who's calling Beth Hammack and saying, I need help, you have to do something with inflation? Because it's not these middle-sized companies. I'm curious, what are the characteristics?
There are some companies right now under serious price pressure, clearly. And you see it in the surveys, in the ISMs. The prices paid component of things, access to goods, the price of goods, just comes up continuously in the surveys.
Yeah, and you see that with respect to, for example, the airline costs and what you're seeing with some of the fuel bills, but the other input costs. And you're seeing this clearly communicated from a number of different places. Question is just, what's 25 basis points going to do? And that's what we keep asking.
Stocks this morning down by about a third of 1% on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. AT&T shares and rising in the pre-market. The company reporting second quarter earnings that beat analyst estimates.
We're executing well. We're hitting on all the cylinders in the engine. And when that happens, the business can deliver the kind of results you're seeing. And I'm pretty confident we can keep that moving going forward.
John Stankey on surveillance earlier. AT&T announcing plans to accelerate buybacks this year. OpenAI saying its advanced AI model accidentally hacked Hugging Face. The ChatGPT maker saying the model broke into the AI model and database host during a cyber capability evaluation. The accidental hack prompting calls for more oversight and regulations on the technology. AMD and Anthropic signing a major chip and investment deal. The Wall Street Journal just reporting AMD will invest up to $5 billion in Anthropic, and Anthropic will purchase up to 2 gigawatts of AMD's latest generation chips. And that is your Bloomberg brief. John.
Vonnie, thank you. This is part of the programme where Bramo gets bored and she's stepping aside.
No, that is not the case. I have an assignment.
Okay.
Absolutely not.
Just to clear that up.
Do not sully my engagement with...
It's 8:46, the new 8:56 for Lisa. Okay. One day away from the programme, it's like, I don't know.
Yeah, it's left in yesterday, and here we are.
I used to do that when I used to anchor the market open.
Yeah,
you know I did.
that. Yeah, no, I remember.
Like 8:40 sometimes.
Exactly.
Sometimes like 8:20.
Glass houses, honey.
I know. Lisa's going to step away. She'll be back tomorrow. Up next on the programme, we'll set you up for the day ahead. Plus, Mona Marjan of Edward Jones on how tech could storm back to lead this market.
It's very much become this volatile trade around stagnation in areas like the Mag 7 and the hyperscalers. The challenge is the Mag 7 years ago had set such a high bar of trumping themselves. That bar, again, has become so much more challenging for rewards here.
That was Meera Pandit at JPMorgan Asset Management weighing in on the high bar for earnings season. Into that high bar, equities declining by 0.4 on the S&P. On the Nasdaq 100 down by 1 full percentage point. Heading into this, ahead of the opening bell, your trading diary shaping up as follows. After the close, you'll hear from Alphabet, Tesla and IBM reporting earnings. Into tomorrow, results from Intel and American Airlines, plus an ECB rate decision and another round of claims. And into Friday, just before the weekend, we get some extra PMI data. Into all of that, stocks edging lower ahead of a massive slate of tech earnings. Mona Marjan of Edward Jones writing, if earnings season delivers on lofty forecasts and the outlooks remain robust, we may see tech resume its leadership, especially in parts of the market that have lagged the most. Mona joins us now for more. Mona, good morning.
Good morning.
When you say that, and I don't want to put words in your mouth so you can tell me what you meant by it, do you mean Mag 7? Do you mean the hyperscalers? Maybe some software names too?
Yeah, look, I think we generally are in a good setup heading into earnings in that parts of the market. So semiconductors had almost gone through a bear market. They were down 20% or so. Now we will hear from them, and we've already heard from the Asian semiconductor names, which blew earnings out of the water. Mag 7 this year has lagged the entire year, down, or actually up 1 to 2%, but S&P up 9 to 10%. So if they can show, if these hyperscalers can show, not only that they're spending more, but of course what we're watching for is there any return on this spending? What does cloud revenue look like? Maybe they'll make commentary on where they're seeing potential return on this investment. We think if they can deliver on those two variables, we can see a little bit of resumption, and markets are looking for a little bit of leadership here. So maybe it comes from that space.
Go through 6 of those 7 names. They were up on the screen just moments ago. Let's bring that back and just go through them individually. I know you can't do single names, but can you describe out of these 6 names the kind of businesses that you're looking to get exposure to? An Alphabet is very different to an Apple, a Meta is very different to a Microsoft.
Sure.
Where do you want to be? Where don't you want to be?
Sure. Broadly, I'd say the hyperscalers are looking more and more interesting if we can start to see the return on that investment. So an Alphabet, as we hear from them tonight, they will set the tone for earnings season, we think. So everything else has been great. The banks have reported well. We really haven't entered earnings season until we hear from Alphabet tonight. And we're not only watching the cloud business, we want to hear what they're thinking about from an investment perspective here. And everyone, all eyeballs will be on what are they thinking in terms of when and where this return will come from. So we know what's coming. We hope that they know what's coming and can deliver on that.
We spoke to Max Kettner of HSBC a little bit earlier. I'm not sure if you're familiar with Max's work or not, but Max has been overweight, Max bullish for a number of years now, for the majority of those years. And until recently, then he wrote this piece and he talked about potentially reducing risk. And what he's looking for is not just the earnings, but how the market responds to those earnings.
Yeah.
And we've had several case studies. Our experience of the last few weeks, Samsung, an example of that.
Yeah.
I can pick another company that have come out with decent numbers and the market hasn't responded favourably to them. How important is that dynamic in the coming week?
Absolutely. And look, we had seen tremendous rise in a lot of those sectors. So a lot of that good news is priced in. You know, we know earnings will be strong. We know the outlooks will be strong. What we're looking for is, can they exceed the forecasts that are already laid out there? So CapEx growth this year, 70 to 80%. Next year, we're not looking for that high of a number, 25 to 30%. So if we're seeing CapEx growth come in line or even above those expectations, that's a good signal to us that this AI cycle is continuing. And we know it's an arms race still thus far, so we don't see the end of the cycle anytime soon.
Do you think those earnings stories in the next week is more important than that Fed decision a week today?
Right now, I would say absolutely yes. I think the earnings story has driven this market. We know S&P returns come from two areas, earnings growth and valuation expansion. We haven't seen much on the valuation expansion side across sectors, really, but the earnings story has underpinned this market. Fed has been on the sidelines, and we think July 29th, they will continue to remain on sidelines. We're hoping we get a little bit more color on what data points they're watching to make their decision. But
good luck, Mona.
Yeah.
I don't think Kevin Walsh is interested in providing it.
Yep.
Yeah. Mona, it's good to see you.
Good to see you.
Thank you. Mona Marjan there of Edward Jones. Looking ahead to a week full of earnings. It starts after the closing bell with Alphabet. That gets the Mag 7 rolling. Picks up next week. Fed decision in the mix. And this move in crude isn't going to help. Just on the margin, we'll just encourage that more hawkish conversation a week today. Crude this morning on Brent around 94. WTI around 87 this morning.
It's going to make that family fight a lot harder next week when the Federal Reserve meets. But for this week, as Mona was saying, this is the catalyst this evening when Alphabet kicks off. And the bar is so high, especially given how much we've already seen this company spend when it comes to the AI build-out.
Crude higher, yields up as well. Futures just a little bit lower on the S&P. We're down by a few tenths of 1%. Coming up tomorrow, we'll break down those results. We'll catch up with Russ Kostrick of BlackRock, Gil Luria of D.A. Davidson, Jim Caron of Morgan Stanley, Osun Kwon of Wells Fargo, and I'm promised, Bradmo's going to be back as well. From New York, thank you for choosing Bloomberg TV. For our audience worldwide, this was Bloomberg Surveillance.